Well, the issue is, and the National Bureau of Statistics highlighted this in their Q1 numbers, 2/3 of Chinese growth right now is in consumption. So Chinese and eating out and increasing expenditure on experiences, doesn't do much for US freight companies, right? But if that can translate in the next quarter or two into investment demand, for the third of the economy, which isn't growing right now, to start to pick up some slack, then I think conditions can stabilize as well. But then China will be looking at the US, if they're looking at the global economy, will Chinese firms expand rapidly as well? Will they invest in size? I think that's the open question right now.
Jeff, just a final question from us. Favorite idea right now for you and the team, what is it?
Well, I think favorite idea in a relative value, and we like euro crosses lower. We're looking at euro yen heading into this week's BOJ decision. Governor Ueda's first press conference, first decision. Any surprises out of there? Valuations wise, I think now that Europe has turned the corner, maybe we will get some during earnings reports. Will they start to worry about earnings translation and like that? But as far as the ECB is concerned, they don't mind a stronger euro. But overall, look at Europe, we'll look at relative value, and we think euro on the crosses a bit lower. Those are the trades we're looking at.
Interesting. Jeff, thank you, sir. As always, Jeff, you there, if BNY Mellon. Wrapping things up in the market, we need to talk about the broader market. We're down by 0.5% on the S&P 500. We need to talk about the earnings. If you are just tuning in, welcome to the program. UPS out with earnings and guidance a little bit early this morning in the last hour, saying that annual sales will come in at the low end of its guidance as US retail sales slow. That stock is down by 5.6%. And then literally just moments ago, more job cuts, not from tech this time. Tom from 3M, 6,000 jobs to go.
Yeah, I wouldn't conflate them together. UPS is a bellwether like FedEx. It's a real tone on the logistics of America, the pulse of America. 3M has been a management train wreck for well over 10 years. They have just, it reminds me of Campbell's Soup, where it's an iconic product that can't get out of its way. And I would say, John, it's been, I don't know if it's 42 or 47 restructurings over a decade. The way I look at this, it's another 6,000 jobs as they try to find out the Minneapolis mining and manufacturing future.
Nice.
Nice.
Otherwise known as 3M. Stock is up by 1.8% in the pre-market. That's the latest from 3M and UPS. A little bit later today after the close, Lisa, we'll talk about Google and Microsoft onto Wednesday, Meta Thursday, Amazon and others onto next week, Lisa. Apple just around the corner.
And this comes after they really fueled most of the gains that we saw so far year to date in the S&P. And so at what point is the bar set so high for this year of efficiency that has to be really efficient? And that hinges on an economy that on the margins looks like it's showing cracks. And that's what we're seeing in some of these earnings, whether it's UPS or 3M with cost cutting. This is not simply hoarding labor in a pandemic. This is a different nature, as you both pointed out, really of job cutting. So given this sort of drumbeat, how does big tech come in here and show that they can still grow?
This line from 3M sees the second quarter continued consumer-facing end market weakness. More weakness through the second quarter. Tom, that's the call from 3M this morning.
I think the guidance is light this morning. It'll be, you see this 10, 20 companies. What do the next 50 look like?
Sure, it's true. We need to talk about UBS over in Switzerland. We'll catch up with Manus Cranny in just a moment. And in the next hour, we'll catch up with the General Motors CFO. Tons to talk about with him a little bit later. Your equity market, negative 0.5%. Yields down 5 basis points. Your 10-year, 354. The latest out of Washington. The president officially launching his re-election bid.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Joe Biden has made it official. He's running for a re-election next year. The president made his long-awaited announcement in a video today, asking voters to let him, quote, finish this job. He'll face a Republican field dominated by his predecessor. Meanwhile, economic uncertainty will cloud his case for a second term. China's President Xi Jinping's efforts to portray his country as a peacemaker in the Ukraine war have been undermined. Now Beijing is trying to extinguish a firestorm caused by its ambassador to France. Liu She questioned the independence of the former Soviet states, echoing Vladimir Putin's views. Beijing said that was a personal point of view and reaffirmed respect for the sovereignty of countries that were once part of the Soviet Union. Meanwhile, the British government is set to unveil new legislation that could lead to a crackdown on Silicon Valley. Big tech firms such as Google and Meta Platforms face more oversight and fines of up to 10% of global sales for practices that hurt consumers. The legislation would create a digital markets unit in the UK's antitrust regulator. UPS is out with a full-year outlook that was weaker than expected. The package delivery service says that volume in the U.S. was lower than expected due to a slowdown in retail sales. UPS also says it faced demand weakness in Asia. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Times of distress in the market. Generally, the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that, particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank, so a sign of confidence of our clients.
UBS CEO Sergio Ermotti speaking with Bloomberg's Manus Cranny. We'll catch up with Manus in just a moment. UBS reporting the weakest quarterly profit in more than 3 years. The stock a lot softer in Swiss trading earlier on this morning. At the moment, the broader market negative 0.5% on the S&P 500. On the S&P, we are a little bit lighter. Tons of earnings out there. UPS, the guidance at the low end of its previous range. That's disappointing investors this morning. 3M with some job cuts, 6,000 to go. That's improving investor appetite for the stock, just a little bit, up by 1.8% or so. And then after the close a little bit later, it is on to tech, Tom, in a big way.
And John, I brought up a random screen on the Bloomberg, and there's many ways to look at earnings, folks. And I really want to partition this, John. I brought up an optimistic screen about the present earnings, this, beat, gain, guide, higher, that. But then you bring up a guidance screen, and it's completely the opposite. Cut.
It's always about guidance.
And there's a real partition today.
Look, the Federal Reserve is struggling to provide much guidance. I think it's very difficult for the C-suite to do the same thing. What was interesting about these UBS numbers, and Manus has got far more depth on this than I have, it's interesting how they played down some of the inflows into the bank.
Yeah.
Played down the idea that it came from Credit Suisse. Played up the idea that it came from elsewhere.
Yeah.
What's interesting about this, and Manus and I, and all of us have had this conversation, so many of those Credit Suisse clients also had a relationship with UBS. And Tom, how they manage that relationship now it becomes a combined entity is going to be interesting. So when we think about who wins? The US wealth management players?
Right.
Who's going to be the winner here?
The winner better be the domestic people of Switzerland, because I thought it was a hugely choreographed set of headlines. I mean, this thing, every drop of the headline was massaged around their present strategy. I think it's interesting they brought in Oliver Wyman, you know, Dan Tannenbaum,
sure,
with Hugh von Steenis driving that ship with his work with Governor Carney. This is a high-level consulted merger to appeal to the Swiss people.
Top line here, a lot of new money from rich clients pouring into that bank.
Yeah, and there it is. And there's one headline that sticks out to me, and it's the only headline for me to talk to Manus Cranny about. Ensconced in Zurich with the Bloomberg News Job of the Week award. Is Manus Cranny here yesterday? Over his left shoulder, Credit Suisse. Over his right shoulder, UBS. Today, only the Union Bank of Switzerland behind him. Manus, there was that single headline, which strategically is what everybody wanted to know, and it was simple. The combination is an equivalent of 7 to 10 years of gathering of assets. Did that surprise you to see how much they brought in and got a 7-year jump on getting bigger?
Tom, thanks for picking the headline, because it defines the current undervaluation of the equity of UBS right now. Look at the 30-day chart on UBS. Let's see if we can bring it up, because therein lies the point. This market has yet to see the real material improvement that Armadi, Kelleher, and Kahn can deliver. Now, here's the rub. $28 billion came in. $7 billion of that in net new money came in after the deal had closed. That is point one. But to your point, Jonathan, the United States of America, the Americas brought in $8 billion of the new money. You had your own banking crisis. Sorry to sort of reawaken those fraying nerves that you have. You had your own crisis, and the American clients ponied up for the net new money. Now, you shouldn't have been able to drive a wheelbarrow past Credit Suisse, load it up, jump the tram, up you go, and wallop it into UBS. That didn't materially happen thus far. There is a caution and a reticence. And of course, it played to Armadi's tune in the interview, where he said, well, Manus, of course, this goes to show that there is healthy competition on the street, and that this concentration risk argument is perhaps a little bit overplayed. He had guardrails up, and I think he was very cautious about the buyback and the timelines, and trying to push him on what would be a measure of success. It was back to the UBS blueprint, Tom, and Jonathan, and Lisa, which is, I've done it before. I've got a roadmap. I know what I'm doing, and I know where I'm going.
But Manus, you raise a good point, and John was talking about this earlier, this idea of the flows not coming necessarily from Credit Suisse, and that being played as a good thing. When is that a bad thing? The fact that if clients have their money in both UBS and Credit Suisse, they will want to diversify their potential risks. They will want to diversify their money managers.
Absolutely, and hence the reason why I take a Thank you. That's the reason why I take a 4-hour train journey to Frankfurt and see what flowed into Deutsche Bank. Don't forget, Ollie was with me. He said Deutsche Bank tanked by 15% as this deal was being done, and there was carnage on the street of Bahnhofstrasse. You know what? Will you bear with me? Because I want to give you a little bit of math. Buffers matter. What have we got? They paid $3.3 billion for $50 billion of equity. AT1, slap it in. You've got $63 billion where you can book losses and write down assets, and losses, and write down assets, and tank a few businesses. Then you've got $5 billion of your own. Then you've got $9 billion from the state. It's a long, long way before you encroach into a negative number of where this deal does not stack up. Buffers matter. Marion Hafler is writing the story as we speak. And when you stack up those numbers, you begin to really understand just how much they have got on side before they really take any pain. Go back, listen to the interview. There's a couple of lovely nuggets. I love this deal. And when it comes to downsizing the bank here in Switzerland, he said, I'm glad you met a lot of experts, man. It's telling me how to actually run a bank and how to renegotiate the contract of engagement. That was the only sort of sense of, ooh, little frustration.
Manus, it was a great interview, and congratulations on it. I do want to just push this forward. There was a sense of trying to expedite at least the closure of the transaction. Do we have a sense of how much they would like to expedite the actual integration of Credit Suisse in light of some of these concerns, in light of some of the investor worries?
he just would not be drawn. So how quickly, did Kelleher set a low bar 3 years to 4 years to do the deal? He pushed back on that slightly, and actually off camera, he just said, look, you got to understand. He said, normally, you go dancing with a potential partner for 2 months, he said, before you perhaps court them properly. This was done in the space of 2 to 5 days, depending on whose reporting you listen to. I think it's sort of post-haste, and it's almost post the deal, the real understanding begins to come. In terms of downsizing and integrating and bringing that investment bank back to 25% of the size of the overall institution, I think it's very clear. He made a very nuanced answer. There's a demographic here in Switzerland, people are getting older. Natural attrition is going to be part of the narrative that they play out to us in terms of downsizing the Swiss unit here in Switzerland. But I've been with Armani for 9 years through the transition at UBS. This is not a CEO who dallies around. He decides, executes, and delivers. And capital is the key, and he wouldn't be drawn when that buyback is back. It's paused, not cancelled.
Manus, you know him better than pretty much everyone else I know. Just fantastic to hear that exchange between the two of you earlier on today. World-class reporting from Manus Cranney over in Zurich, yesterday on Credit Suisse, this morning on UBS, with Sergio Ermotti trying to integrate an absolute monster, Tom, in Zurich, Switzerland.
We've been through this 20 years ago, 25 years ago, where it was SBC, Swiss Banking Corporation, and UBS. What they did is they kept it as, they brought UBS into SBC, but they renamed it UBS. It's a little confusing, but they've done this ballet before. To be honest, Manus had my head spinning with the math. I couldn't keep up with the cranny mathematics. But the answer is they've done this before. They have the government behind them to get this done correctly. And there's again, I go back to what we're missing in London, missing in New York, missing in Hong Kong, which is this is a domestic roll-up. I could talk about the great zombie roll-up. Maybe this is the greatest zombie roll-up of the year.
Well, Manus framed this as a relationship, and the management over at UBS want to make out that this happened really quickly. They didn't have time to think about it. Their friends in the banking world have been playing matchmaker for 5 to 10 years on this deal. It's not like it came out of nowhere, is it? It's like those two friends that you think should get together.
Yeah, exactly.
And then finally one of them is desperate enough that it has to happen.
Do you want to talk a little bit more about that?
Would you like to expand on this?
I'm not just for the record.
All right.
Just for the record.
All right, but just to put that...
I'll get my camera up just quickly and make it very, very clear. I'm not talking about any of my friends, none of my friends, just thinking,
Wait, where's this? I'm getting broadly. A message right now. I will say, though, this is the issue. They had time. The math didn't make sense, Tom. It didn't make sense to a lot of people. And people are still trying to parse through it all to understand it.
He had a parsnip and coriander soup priced at $25
So expensive, that's
Zurich
ridiculous.
Is like...
It's nuts.
Is Manus a gnome of Zurich?
In the next hour, we'll talk about the earnings that have come through in the last hour. Plus, our top story this morning, President Biden launching his re-election bid. We'll head to D.C. in just a moment.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
To deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everything rolls back to the Fed and their super aggressive policy last year.
The Fed's conviction around bringing inflation down to 2% is very clear.
I've been thinking of a fun word to describe this as slowflation, slow growth, and inflation that's still going to be more stubborn than you would have liked.
The Fed will have to keep interest rates higher for longer in order to get inflation back to the 2% target and maintain it there.
Before the end of this year, we will be at a level that's pretty consistent with long-term inflation expectations that the Fed wants people to have.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
If you wanted a quiet morning, you're not getting one. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Tuning into an equity market down by 0.4% on the S&P 500. Lots of earnings to talk about. Lisa's going to jump in on that in just a moment. The top story, 60 minutes ago. We've been waiting for this one for a long, long time. Literally since before Christmas, before Thanksgiving, when Ron Klain was at the White House back then and told us, after the holidays, you might get an announcement. And here we are at the end of April with this announcement. President Biden launching his re-election bid. The president making a formal announcement in a 3-minute long, highly produced video about 60 minutes ago, Tom, for a second term.
Yeah, it's here, but your point is really well taken, as it took a while, but yet the pros that we talked to, like Greg Villiers, like Amory Horton, said, no, this is about the right time. I think there was a let's go, and a lot of the Washington people were saying, no, it says April, and that's where we are. We'll be at the White House Correspondents' Dinner this weekend, and it will be a re-election president greeting us.
Greg Villiers of AGF was pretty blunt in the last hour when he turned around, Lisa, and addressed that phrase the president's been using lately and again this morning, let's finish the job. Are people happy with the job he's been doing? Never mind finishing it.
You pointed to that NBC poll talking about how 70% of people do not want to see him run again. And I think something like 60% do not want to see the former President Trump run again. So this is a highly unpopular pairing that looks like the most likely pairing heading into election season with a lot of issues economically, geopolitically on the table. So here's the question. Where is younger, other leadership, and what's it going to look like at a time of such heated polarization?
I agree, it's odd, and of course we had to go back. The surveillance team, my interns researched this morning, John, and we can bring it back to England. I woke up one day about 3 years ago and realized I knew nothing about William Gladstone, and I read a quick monograph on the great British politician of the 19th century. John, the last time Gladstone was prime minister, 82 years old in 1892. So there is a precedent here.
At the end of his second term, he will be 86.
Yeah.
That's the elephant in the room right now. And Lisa touched on that NBC News poll, within that poll, about how unpopular this run might be. And I can go through the numbers and share them with you just briefly. 70% of all Americans, including 51% of Democrats, don't want President Biden to run for president in 24. And nearly half of those respondents cited his age as a major reason. This is something we can talk about with Anne-Marie in just a moment. We also need to discuss the earnings this morning. So about 60 minutes ago, we heard from United Parcel Service, UPS. UPS coming out and saying annual sales will come in at the low end of its guidance. That stock is softer this morning. Then we heard from 3M. 3M coming out and saying they're going to have to cut jobs by 6,000. Cut the workforce by 6,000. So UPS is negative almost 5%. 3M is positive by 1.4%. And Lisa, moments ago, an update from McDonald's. I'm looking at EPS at 263, the estimate 231.
Yeah, the comparable sales for the first quarter up 12.6% versus the estimate of 8.2%. So a pretty big beat. And this follows on what we saw from PepsiCo earlier this morning, also with a beat. So if you're looking for themes, what it seems is the most industrially facing companies are facing some headwinds right now. We're looking at whether it's 3M, whether it's this idea of UPS, and then FedEx, those shares following on. If you're going to eat something, particularly if it's on the lower cost end, consumers are willing to accept price increases, and we're seeing that at McDonald's. We saw that at Coca-Cola. We saw that at PepsiCo. And this, to me, is the divergence that makes it so difficult to come up with a clean narrative about this economy.
Let's wrap up this price section for you. If you are just tuning in, welcome to the program. We're negative 0.5% on the S&P. Yield to lower by 5 basis points. Your 10-year 343.91. A break of 350 in yesterday's session. Some softer manufacturing numbers, which speaks to some of the stuff that Lisa's discussing in the FX market. Just about holding on to 110 here on euro-dollar, Lisa. Even with euro-dollar negative, about 0.2%.
Yeah, you're looking at the Dallas Fed manufacturing data we got out yesterday. Today we get housing data like FHFA house price index for February, as well as new home sales for March. But to your point, in addition to U.S. Conference Board consumer confidence for April, we get U.S. Richmond Fed manufacturing for April. That might be the most interesting based on some of the disappointments we've seen recently. Today, the earnings do continue. We get Bank United and Community Bank System before the bell, and I'm really focusing on those small regional banks. PacWest after the bell at about 4:20 p.m. following what we saw from First Republic yesterday. We're now worried about the regionals again. That seems to be the new theme, that those sort of feelings of confidence that we had stabilized, perhaps taking a real test after some of the results that we've gotten recently. And today, we do get also earnings from the tech giants, including Alphabet and Microsoft, in addition to Texas Instruments after the bell. That has been what's driving the gains so far this year. Alphabet up more than 20%. Microsoft up almost 18%. How much is this a chat GPT-fueled rally?
Well, they give us guidance. McDonald's really didn't give us guidance forward. There was a dearth of guidance there. It'll be interesting to see the guidance off of big tech. One quick note here on the banks, you got to watch commercial real estate. I'm reading on it as hard as I can every day. Cranes is really helping me on this, city to city, to look at individual properties with huge haircuts on sale.
It's something that Mohamed Al-Arian talked about last week. He said you can't call this a credit crunch. It's not going to be a broad-based economic contraction.
Strongly agree.
In lending.
Yes.
But what he does think, it will hit pockets of the economy in bigger ways than others, and perhaps commercial real estate's a feature of that, Tom, if small banking has to pull back.
Well, it is a pockets of the economy, and that goes to the political tinge here as well with the president's announcement of re-election. Is the candidates, and the two candidates to go to November 5th of 2024, they've got to segment parts of America to win.
The president making a formal announcement for a second term. The phrase, let's finish the job. Let's head down to Washington and catch up with Bloomberg's Anne-Marie. MH, the words from the president this morning. The question we are facing is whether in the years ahead we have more freedom or less freedom. I know what I want the answer to be, and I think you do too. This is not the time to be complacent. That's why I'm running for re-election. The thoughts of Washington this morning.
Well, I think this was highly expected. We even knew that announcement could come as soon as this week or as soon as today. This is Biden actually on the anniversary of announcing his first campaign when he won and ran for in 2020. So this has some nostalgia to it. But really what this sets up is Biden is able to get a team around him outside of the White House to just focus on his re-election, because obviously he's still president of the United States and he has everyday jobs that the leader of the free world has to tend to. And also, really, this gives him a chance to make sure he can start talking to donors. And there's set to be a donor conference, if you will, likely on Friday. So this sets up him going to 2024. It also really now means that there's a lid on the whispers on whether or not Biden will run or not, even though, Jonathan, as you said, Ron Klain's come out and said it. His wife has come out and said it. Dr. Jill Biden, the First Lady. They've all said he's running. Biden even told the weatherman, I am running. That was on the Easter roll on Monday. And now he finally has this highly produced video. And now the game starts with coalescing the team around him.
In my recollection, I'm going to go all Greg Giroux on you, Amory Horton, our wonderful guy, county to county across America. It ends up in the suburbs, I'm going to say as a generalization. How does Joe Biden win again in the suburbs?
Well, I think he's going to use a similar playbook for 2020, which is the concern about the former president, Donald Trump. And this is going to be with independents and especially women. I think abortion is going to be a huge issue for women going into 2024. And we already see Republicans are struggling with how they're going to message on it. You even had the head of the RNC saying on Fox, we do have a messaging problem when it comes to abortion because they don't have a unified message. That is going to be one key issue the president is going to want to talk about when he goes into 2024 and he tries to get the suburban vote, especially suburban women and women in general. The other key issue, of course, is going to be the economy. So Biden is going to have to defend his record while running this campaign. And with the economy, that could be a challenging moment because obviously we've seen inflation and already this is where the Republicans want to take the debate. RNC is out with a statement saying Joe Biden wants to finish the job, but what does that job mean? Sky-high inflation. That's how they are going to frame his reelection.
How much of President Biden's reelection campaign is hinged completely on the former President Trump actually running? Because President Biden seems like, again, probably the most likely person who could beat him.
So when you look at some of the polls, it does look like there could be another Republican candidate who could beat Biden. There were some earlier polls that person could maybe be Governor Ron DeSantis, but that Biden still beats Trump. So this is almost just a rematch of 2020. And as you guys have been noting, that NBC poll, even though the sample size does look quite tiny for how many people were polled in that, it doesn't look like America wants a rematch of 2020. But where the direction of travel is, it looks like they are getting it. One, obviously, we have President Biden today formally announcing for 2024. So he's obviously going to be the nominee for the Democrats. He's the sitting president. But then for the Republican side, it is the former President Trump who is winning in these polls. And then there's a very interesting article this morning in the New York Times about the big donor for Governor DeSantis, who, by the way, is on a world tour right now and got a VIP greeting in Japan, that he is concerned about some issues, according to this reporting, Ken Griffin, regarding the 6-week abortion ban and also DeSantis's comments on calling Russia's invasion of Ukraine a, quote, territorial dispute. So potentially you're going to start to see some of these individuals that people really thought could potentially beat Trump in the primary actually start to fade away.
It's amazing how many articles I've seen in the last few days declaring the end of a campaign that was never announced by the governor of Florida. Just amazing. AMH in Washington. Anne-Marie, thank you on the latest. The president making a formal announcement to run for a second term. Tom, it's super early days. I think a lot of people already running away with the idea that it's going to be a replay of the rematch of what we saw last time around.
That's a zeitgeist. No question about it. That's a zeitgeist. It'll be a rematch. But I'm really on the fence on it. And as we've all said here in the theme of 2023, there's so many financial narratives, market strategy narratives, and guess what? The political narratives of this nation now, I can't make sense of it.
I would go one step further, even if it is a rematch, and I stress again, it's incredibly early days. Hard to make the case, Lisa, that it will be a replay of the same campaign. The last campaign was about a referendum on the sitting president, Donald Trump at the time. This time around, President Biden has to defend his record. He can't just hide away and make it about the other guy.
It's also the unspoken truth that both parties are so splintered and they're not clear how to bring some unity to either side.
Equities right now negative 0.4% on the S&P 500. The latest news in Washington, President Biden launching his re-election bid. We'll cover that through this morning for you, on top of a ton of earnings through this morning and onto this afternoon. After the close, you will hear from Google and Microsoft. It's big tech's turn after the closing bell.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden is asking voters to let him, quote, finish this job. The president has formally announced that he would seek re-election next year. In a video released today, he said there is still work to do to give Americans a fair shot. The president criticized what he calls extremists in the Republican Party who want to cut government spending and curb abortion rights. Shares of regional bank First Republic plunged in pre-market trading. The bank's quarterly results reignited investor concerns about prospects for its business. Customer deposits plummeted 41% in the first 3 months of the year. Figures underscored that First Republic is still contending with the impact of last month's regional banking crisis. House Speaker Kevin McCarthy is refusing requests from fellow Republicans to change his $1.5 trillion debt ceiling proposal. Bloomberg's learned the bill will be sent to the floor for a vote this week under a rule that does not allow amendments. If as few as 5 Republicans oppose the measure, it would be defeated. General Motors posted first quarter profit that beat estimates. The automaker also raised its full year earnings and cash flow guidance. GM's stronger results came from rising sales in the U.S. despite higher interest rates and inflation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think tech outperforming, that could be forward expectations and forward easing expectations coming through. If we go back to last month, some of the best days for tech were when Fed cuts as early as June were priced in. So I think that relationship between financial conditions and tech we need to look at as well.
Jeff, you in the last hour of BNY Mellon pushing ahead to tech after the closing bout. Google and Microsoft a little bit later today. On to tomorrow, we'll hear from Meta, Facebook. Then after that on Thursday, Amazon. On to next week, we'll hear from Apple. Moments ago, we heard from GM. Beat and a raise from General Motors. We will catch up with the GM CFO a little bit later on. Their stock is higher by more than 3%, Lisa, beating first quarter profit estimates, raising full year earnings guidance.
Which really shows, again, the bifurcation of the haves and the have-nots. We've seen disappointments in other auto companies, and this is sort of interesting. Who has the pricing power? Who has the dominance? Who has the products that people want? And who's going to emerge the winner in the electric vehicle race, given the fact that that's really in the forefront? There was someone talking yesterday from a Chinese EV company saying only 10 will emerge in this field.
GM banded back to early 2022. It's been in a trading trading range and sort of on the bottom of that range, and it's a nice lift up. And my question, John, with this is use of cash, given as a general statement, pretty good earnings, and the guidance is a little moldy, ex McDonald's and a few other constructive stories, but they really got to come out and stake cash. And UPS, the big brown, said we're going to continue to do share buybacks along the way.
One question for GM, price cuts at Tesla. How are you reacting to price cuts at Tesla?
Yeah,
what do you do?
Is EV valid? I think is where I would start with the CFO this morning. David Rosenberg channeling John Farrow this morning. Give me the tweet from Rosenberg here. He's recovering from the Montreal Canadian season. Don't be fooled by a 2% print on Q1 GDP growth. More than 100% of the pickup was in January. March GDP contracted as we head into Q2 momentum. You mentioned this, John, that the quarter's distorted by a bang-up January.
Warmer, much warmer than anticipated. Forgot about that, didn't we? We kind of escaped winter over Christmas and into the new year. Just escape winter.
Also,
what happened to the cold weather?
But also, as Blanchard says, the Biden stimulus was still there and it's drifted away quickly.
Well, resilience is the word that you hear a lot this earnings season. Resilience to the consumer. But now we're starting to see some cracks. Jobless claims a feature of that story that I think we can point to. More broadly, though, you wake up this morning, the S&P is negative 0.5% on the S&P 500. Yields are lower by 5 basis points on a 10-year, 343.91. We can talk a lot about the market. We will do through this morning. We'll also return to that announcement from the president in the last hour, finally getting it done. Been talking about this for so long, we can actually talk about it now. The president making a formal announcement, Tom, to run for a second term.
It's there, and I think the coverage that we've had this morning has been great about it. What does he do in the next week? I mean, you know, it's 560 days to the election. What does he do? How do you jumpstart this? Run another video? I'm curious. Go have a campaign event?
Do some interviews. That would be nice.
Yeah.
Some one-on-one interviews.
I mean, Lisa,
nice
you
to see
mentioned
more of
this.
that.
You did a video. I mean, I just, you know, I wonder where we go on this. What we're going to do is futures negative, what, John? Negative 22 we got to, negative 25. We're back to negative 18, a little bit of a lift in the tape. Sarah Hunt now leaned forward on this on the equity markets with Alpine Saxon Woods. Hugely popular because she participates in the market while others are afeared. With the guidance out there on earnings, are you afeared? Are you afraid of what's to come?
I'm not sure that afraid is the word that I would use, but I'm definitely cautious given the fact that the equity market is sort of at the top of its range. It kind of got to that 4,200 level and then back down a little bit. I think we have to worry about what's coming down since most of the earnings estimates are weighted very heavily towards the back half of the year. And if you listen to people's guidance, which I think everyone's going to be doing in Q1, we want to hear about the whole year's cadence. We don't just want to hear about what happened. We want to hear about what you're expecting. And I think that, you know, UPS coming in with lighter package volume on the margin, I think the news is a little bit more cautious for that uptick in the end of the year. So have we pushed out a slow, shallow recession into 2024, or are we going to not get the pickup at the back half of the year that we're looking for? I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
On the surface at the index level, you indicated this, it kind of looks calm. Pretty muted price action last week through the month so far. This well-defined trading range we've all discussed around this table repeatedly, 3,800 to 4,200 year to date. Does that mask something more sinister beneath the surface?
Well, if you look at the fact that really the top 10 stocks have been something like 80% of the performance of the S&P so far, and the NASDAQ is very top-heavy, and those stocks have done very well. I think underneath, the rest of the S&P is up maybe 1% in Q1, so I think that there's definitely a divergence in the action of stocks, and those big stocks that were sold off very heavily last year were reinvested in this year very heavily. So you've these big swings in these big stocks, and the question's really going to be, what are they doing with their CapEx? Are they pulling back or not? Because that's going to be a big part of the story for earnings for everybody else besides the big tech guys. And what's happening underneath on some of the things because of these regional banks? I mean, I think the real question is credit really going to be much tighter? Anecdotally, I've seen stories that say it's very much harder for people like property developers to get loans and things like that. I think all of those things are that slow-moving, long and variable lag that is starting to catch up. And I think that that's a little bit of a worry in terms of the expectation that earnings are not going to be down year over year, but they're going to be up slightly, and a lot of that, again, is weighted to the back half of the year.
So then when does this divergence become convergence? I guess that's one question, because you're seeing this strength in GM, for example. Let's use that as a poster child, saying that they're expecting profits to increase above people's expectations, that demand in North America is still strong, and they derive most of their revenue from the North American market. So how much can you say, great, that means that things are going really well in the United States versus they have pricing power and they've managed their inventory really well?
I think this is the biggest problem, right? Because you also look at sectors like the airline sector, that's doing very well because everybody wants to travel. But you have other sectors that are not performing as well, and whether or not the rest of the auto game can work as well as GM is working right now. And that's also looking behind us. What about looking forward? Can people get credit? Because the people who don't need to get credit to buy a car can go buy a car. But the people who need credit, that's becoming a question as you look at things like Ally and other financiers who say, you know, this is going to be different. We're going to pull back on credit. So I think that's part of the issue right now.
People are talking about big tech starting after the bell today as possibly the bellwethers for this earnings season. Do you agree with that, or do you think that it lies in the industrials or elsewhere?
I think that this goes back to the fact that we have such a, I mean, bifurcated is too simple because that's only two things. There are so many different actions weighing on the different sectors that it's almost like you've had a slow rolling recession in different parts of the economy since last year. So it's not like everything's going down at once or everything's going to go back up at once. You've got all these different moving parts, and some of them are doing much better than expected and some of them are not. And some of them, when they do well, the stocks don't reflect that, or when they do poorly, the stocks don't reflect that. So it's been a very challenging period of time because even if you're right theoretically, it doesn't mean that the market is going to react the way you thought it would react in, you know, what you think of as sort of more fundamental terms. So I think that that's part of why it's been such a challenge last year, and I think this year too.
Exxon, Friday. It's one of your favorite sectors. Let's talk about energy. What are you looking for this week?
Well, I think that you've seen oil prices come up, right? So that's going to help, but that's very recent. So was the first quarter, what was the average oil price? Is that going to be really, what are the margins going to do? You saw Halliburton come in today. Halliburton had great numbers.
Use of cash. Exxon, GM, and the rest. When are we going to get some courage to deploy cash to shareholders? I just don't see it.
Well, if you're Exxon, where are you going to get that courage from, right? You're basically being told by the whole world that no one wants oil after a certain period of time. Now, when that period of time is, it's going to keep changing because I don't believe it can be in 10 years. But how much more am I going to invest? I mean, I think that's part of the issue on oil prices right now is the supply constraints because people haven't been investing.
Their dividend growth is totally unacceptable. I mean, am I an old fogey on this where it's all about share buybacks and it can't be about dividend growth?
No, I think you need to do both. And I think that when you do both, you telegraph that those cash flows are not temporary, that they are more permanent. But the problem for the oil companies, again, is you're being told basically by governments, we want you out of the oil industry. So how do I justify to my shareholders or to myself investing a lot of money? Now, they're doing it in some cases. I mean, again, Halliburton just had good numbers. You're going to see better numbers on the oil service side because you've seen investment start to pick up. But I think that the problem for some of those guys, and for, is the cyclicality. So GM, I've got a great year this year, but if I increase my dividend, I have a bad year next year. Yep. What do I do? Do I cut my dividend? Because investors don't like that.
Sarah, this was awesome. It always is. Sarah Hunt on the Energy Patch. Exxon reporting later this week from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Live from New York, equities down just a little bit. We're negative on the S&P. On the NASDAQ too, on the S&P 500, we're negative 0.4%. On the NASDAQ 100, down 0.3%. Big afternoon coming up for the NASDAQ 100 a little bit later. Google and Microsoft reporting after the close. Lisa will go through some single names in just a moment. I want to run through the bond market yesterday. Dallas Fed manufacturing, softer than expected. That brought down yields on a 2-year, right the way through the curve, actually. We're still north of 4%, but only just about on a 2-year. We're down 3 basis points, Tom. We're back to 4.05% on a 2-year maturity.
And the real yield is coming in again. It's not to where I can interrupt and say this is a big deal. It's not. But the trend there changed with that economic data yesterday.
Break of 350 on a 10-year, 343.72. We're down 5 basis points, pushing through to next week. Federal Reserve, May 3rd. ECB May 4th, going into it all. The euro just about holding on to 110 on euro dollar. We look like this, 110.20. Lisa, with negative 0.2% there, negative 0.2% going into those central bank meetings next week.
And then, of course, dun, 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 the key moment, May 8th, the senior loan officer survey that everyone's been waiting for all of this time. In the meantime, we have gotten a ton of these earnings that are actually fascinating. Looking at UPS, that's where I want to start. They said that annual sales would come in below or sort of on the lower end of the guidance as expected by analysts. They cited slowing demand for U.S. retail. They also cited slowing demand over in China. Those shares down about 4.7%. Interesting to note that those shares were up about 13% year to date. So an outperformer so far in 2023, but let's see how long that lasts. FedEx following in sympathy down 1.4%. And 3M, we've been talking about this. The year of efficiency isn't just necessarily for big tech because they're planning 6,000 job cuts, those shares rising by 1.7%. But what does this say about how the nature of job cuts are changing at a time when really the way to boost income is simply to increase efficiency in a new way? I'm also looking at the banking sector. We got First Republic earnings yesterday. It was really unimpressive, to put it mildly, especially given the fact that there was no press conference. Those shares lower by more than 21%. And then the other regionals falling in sympathy. PacWest, we're going to be getting today at 4:20 p.m. 3.7% loss ahead of the open, or 3.5% loss now. That was what it was earlier. I'm looking at Western Alliance as well, which already reported earnings down 2.5% in sympathy with First Republic. And then I wanted to say, just to finish up on General Motors, those shares popping by 3.2%, expecting their earnings to come in at a higher end of expectations for the full year. We're going to be speaking with the CFO, Paul Jacobson, just coming up here in about 15 minutes. It'll be fascinating to see, John, what he has to say at a time of so much change in the industry, of pricing pressures in EVs, and also potential cracks in credit that are emerging from some of this banking stress.
Price cuts at Tesla. Price cuts at Tesla.
First question.
Did I mention
First
price
question.
cuts at Tesla?
First question.
Are you responding?
David Welch calls me up
Sitting
at
there
2
watching it
a.m.
happen?
David Welch, Bloomberg, Detroit.
Sure.
If you don't ask him about Tesla, I'm never going to speak
You
to you
mentioned
again.
GM, every morning that happens, they're like, again?
Yeah.
For goodness sake.
What are we, chopped liver?
It's like, the fourth time in a year, something like that.
It's Clay Christensen. It's disruptive to say. And the news flow is extraordinary, John. This goes all through next week. It goes well into Apple. The Fed meeting.
Yeah, May 4th.
And then Apple May 4th. So it's an earnings derby here, overlaid with politics and the rest. Right now, we are thrilled to bring Amanda Lynham with us, head of macro credit research at BlackRock, with really interesting view of the credit market. All in all, I look at the turmoil out there in equities. And I want you to bring it right away over to the bond market. Are you clipping coupons? Do you have the scissors out? Does Larry have you in the basement and you got the scissors out clipping coupons? Or can you actually manage and execute total return in bonds this year?
Right. Thanks, Tom. It's great to be here with all of you. We absolutely see a really attractive opportunity in fixed income. I think Lisa, though, suggested earlier in the program, there's a bifurcation between the haves and the have-nots, and that's absolutely something that we're focusing on in the corporate credit market. I think one of the really interesting points is adjusting to this higher cost of capital environment. And so from our perspective, the disruption in the regional banking system, the pullback in credit that we expect is going to have different implications for different parts of corporate credit. Taking the U.S. leveraged loan market, for example, we've seen a doubling of interest costs in 4 quarters. And so that's really something that I think we're paying a lot of attention to. Now, for asset allocators, you are actually getting paid a lot more for that risk. You're picking up around 200 basis points if you looked at single B loans versus single B high yield bonds. So there is a real relative value dislocation that you have to manage there, but that's really what we're watching going forward. I think the two things that are really important is that even a period of just below trend growth in a higher cost of capital environment should warrant a rebuild of risk premia in corporate credit. And then the second thing is, unlike the period of the past 2 decades, we are actually seeing some differences in the way that that stress is manifesting. So, for example, we're seeing the loan default rate outpace the high yield bond default rate, which is something that hasn't happened for most of the past 2 decades. We think that that will continue. We think that there will be differentiation between sectors as even some of these corporate companies and sectors have to refinance into a higher cost of capital environment, say in the high yield bond market. So while we absolutely see an opportunity in fixed income, it's really important to tread carefully. We're paying a lot of attention to sector allocations, parts of the curve. And ironically, as Lisa, I'm sure you well know, high yield has actually outperformed IG so far year to date. So for all of the concern about downside risks to growth, we actually haven't seen that manifest in the lower quality parts of the market.
Jeff Gundlach, a double line, I think, said to CNBC a number of weeks ago, have you ever seen a high-yield bond mature? Because they always just refinance. When they come to refinance next time around, where is that big maturity wall, so to speak? Is it off in the distance? Is it close? Is it right the way out there? Where is it?
It's 2025 for the most part, but we know that high-yield companies typically don't let their bonds mature. They typically address them 12 months or even before, unlike IG, where sometimes they're actually replaced. They mature and they're replaced or refinanced with very short windows. For the high-yield bond market, we are seeing that activity pick up. I wouldn't say that the new issue markets have been exceptionally active, but we're definitely past the lull of March. And really, I think that's a trend that will continue because if we're looking at kind of refinancing needs through 2025, corporates will have to start to address that in 2024. And it's not really clear to me, given some of the overhangs on growth, the debt ceiling, what will be better about the market in the second half of the year versus now.
So what's the bigger risk right now? That the Fed's going to hold rates higher because of strength in the economy, which would be positive for some of the riskier credits, or that the economy deteriorates, that yields go in, so all of a sudden this looks like high yield truly, and yet it's not really a good environment with respect to their corporate bottom line.
Absolutely. I think John and I talked about this a couple of weeks ago where we kind of saw these two different paths, both of which were probably warranting rebuild of risk premia. The first is you have a recession, you have the Fed cut rates because the downturn in growth is so bad, but spreads respond to that and move wider. Or you have, on the second hand, maybe the bank contraction in lending isn't so bad. Growth is below trend, but not recessionary, and inflation is still elevated and the Fed stays on hold. And in that instance, you have corporates adjusting to a higher cost of capital environment. And I think either one of those warrant a rebuild of risk premia. I think they manifest, though, in different ways. We know that the high yield market is more sensitive to downside risks to growth. And so I think that recessionary outcome would warrant a more pronounced repricing in spreads. But either way is challenging to navigate.
So how are you allocating? Because on one hand, you are going name by name, but there has to be a scale kind of
For sure.
issue here.
Yeah.
So how are you sort of divvying up the risks at a time when you also need to rent, not
Yes.
only just own?
Yeah, we're leaning into high quality, high yield. Front end of the curve is inverted, and so we're still leaning into picking up yield in that position. And then we're looking to deploy capital tactically. I mean, it's really a lot of attention to sector allocations, idiosyncratic stories, very mindful of an uptick in distress and defaults that we're kind of managing through off of a very low base. But we do absolutely, I mean, see an opportunity with yields where they are. You have to stay invested, and you really do need to lean into those exposures, but it warrants a lot of caution in our view.
Let's get to the topic that everyone loves to hate to talk about, debt ceiling.
Yes.
You've written about it.
Yeah.
Does that apply to credit? Does that story, is that something I need to think about, or can I avoid it?
It does apply to credit. If we use the 2011 episode as an experience, we saw that high yield spreads widened around 40%. So the 500s range to the 700s range. Of course, we had an equity market decline, peak to trough, over a few weeks of 17% during that same time frame. We also had the European debt crisis in the background, so a bit hard to disentangle the 2011 experience. But absolutely, I think it's something that weighs on risk sentiment for sure. And
off your remit, you studied this at Villanova a million years ago.
Yes.
Is there an efficacy to studying credit default swaps? I mean, they don't have the liquidity you're used to, but is there a value? The hysteria that's out there, John, in the U.S. CDS right now, is that a valid study?
It's an incredibly technical market. I would say the widening that we've seen in the, for example, the 1 year U.S. sovereign, it's moved from an extremely low level of 15 basis points to something around 110,
Is the market
115.
deep enough?
I wouldn't necessarily take that as the major read.
Thank you.
I think really the dislocations in the T-bill curve are notable. I do think that as we get closer to when the X date will be, that the market will pay even more attention to this. But to the point on, does it matter for credit? I think it matters for risk appetite, which matters for credit and equities, but it also matters for sectors. And so there are certain sectors, certain companies that have a large portion of their revenue and earnings tied to government spending. And so if we see cuts to discretionary non-defense spending, for example, you would expect that maybe perhaps those budgets might be reined in.
Is that weakness you would buy?
I think until we get some clarity on how this path forward looks, I think it would be difficult to get super constructive on it. It's not clear to us that this will be an easier process versus 2011.
Why is that?
I just think there's a significant amount of uncertainty, slim margins. I think it's not clear where a lot of the party lines stand on terms of where the obvious cuts for spending decreases are.
I don't know about you, but for us, whenever we try and have this conversation with anyone on Wall Street, there's just kind of pushback. It's like, it's happening, it's out there. Yeah. What about you when you speak to clients?
I think it's for the immediate portion of March, a lot of the focus was on the banking sector, and rightly so, downside risks to growth. I think now that we've kind of moved past the immediacy of that, market participants are looking around saying, okay, what else is on the horizon? Certainly, though, I think it's difficult to have a game plan when we don't know when that X date will be, and so we're waiting for the tax receipts to see, is that early June? Is it late July? Is it later in the summer? I think once we have some clarity on that, I would expect folks to kind of focus on it even a bit more.
Amanda, this was great. It always is. Thanks for being with us. In studio, Amanda Liner there of BlackRock. Brahma, you get the feeling that's becoming a bigger story slowly, and then it will be all at once at some point in the summer.
If you look at T-bill yields, 1 month versus 3 month, the 3 month is yielding the most relative to 1 month going back to the early 2000s. So just to give you a sense of some concern.
As Amanda said, you're starting to see it there in the T-bill curve. Equity futures right now, negative 0.5% on the S&P. Up next, we'll catch up with General Motors CFO with a stock up in a pre-market off the back of a beat and a raise. That conversation next.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Joe Biden has made it official. He's running for re-election next year. The president made his long-awaited announcement in a video today, asking voters to let him, quote, finish this job. He'll face a Republican field dominated by his predecessor. Meanwhile, economic uncertainty will cloud his case for a second term. China's President Xi Jinping's efforts to portray his country as a peacemaker in the Ukraine war have been undermined. Now Beijing is trying to extinguish a firestorm caused by its ambassador to France. Liu Xi questioned the independence of the former Soviet states, echoing Vladimir Putin's views. Beijing said that was a personal point of view and reaffirmed respect for the sovereignty of countries that were once part of the Soviet Union. Meanwhile, the British government is set to unveil a new legislation that could lead to a crackdown on Silicon Valley. Big tech firms such as Google and Meta Platforms face more oversight and fines of up to 10% of global sales for practices that hurt consumers. The legislation would create a digital markets unit in the UK's antitrust regulator. Verizon reported first quarter profit and broadband subscriber gains that beat estimates, and that helped offset a larger than expected loss of mobile phone customers. The overall subscriber gains mark what could be a turning point for Verizon's consumer business. It struggled the last 2 years and fallen behind AT&T and T-Mobile in wireless growth. And job cuts are on the way at 3M. The Minnesota-based manufacturer plans to eliminate 6,000 jobs as part of a wider restructuring. The cuts are expected to save up to $900 million. 3M posted quarterly earnings that beat estimates. Sales fell less than expected. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
If you look at market pricing, it's essentially a probability-weighted, view of the world, right? And so the Fed cutting 25, 50 basis points before the end of the year, there's a much higher probability that the Fed's going to cut 100 basis points if there is an accident, or cut 0 if inflation is sticky. And so what you see in market pricing is a weighted average of that.
And Al Husseini there of Columbia Threadneedle. To put it simply, we've either priced too many rate cuts or not enough. He's not the only one saying that. We've also heard that from Gershon Distenfeld of AllianceBernstein and Neil Dutter of Renaissance Macro. That's a theme for later on. The theme right now, earnings. Let's talk about the market more broadly on the S&P 500. Softer throughout this morning, negative 0.5%. UPS, a little bit earlier on this morning, missing with some expectations at least, saying annual sales will come in at the low end of guidance as US retail sales slow. That stock is negative in the pre-market. 3M doing a little bit better off the back of some job cuts. 6,000 jobs to go over at 3M potentially. So that's the latest news for them. A little bit later after the close, we'll hear from Microsoft. We'll hear from Google. The bright spot as well, though, Tom, came from GM, General Motors. GM this morning, a beat and a raise. The stock is up by a little more than 3% in early trading.
The quality story is a transition from fuel to EV, which is, of course, the focus of the industry. I know John and Lisa have a few questions on Tesla, to say the least. Joining us now, the gentleman from Auburn, Paul Jacobson, joins us, Chief Financial Officer at General Motors. Paul, you drive the Hummer EV. It clocks in at $85,000, marked up to the proper Paul Jacobson level. It's maybe, 95,000, whatever it is. The answer is you boosted the range on a 9,000-pound vehicle. Does America want that? Is there real demonstrable evidence that broad America wants to drive EV?
Well, good morning, Tom and Lisa and John. Thanks so much for having me. First of all, let me say thanks to the GM team for an excellent quarter and the confidence that we have going into the year. You know, when we're looking at EVs, you know, we have really strong demand for everything that we've produced so far, and when you look at the order backlogs and the ramp up of cell capacity, we feel good about our ability to ratchet up production to meet that demand. But you know, consumers are speaking with their commitments to us, and we feel good about the products and the vehicles that we're producing. The Hummer EV is just it's a great vehicle engineered by our team.
Here we go.
And customers can't get it fast enough.
You know, I look at this, Paul, and it is unit and price. Mr. Musk is playing with price, it seems like on a weekly basis at Tesla. I was talking to our David Welch in Detroit. It's real simple. How do you adapt to Tesla's price strategy? Is it something you react to? Is it something you ignore?
So we've actually been very consistent with our pricing on our EVs, and that's really a function of the demand that we've seen for them. So, you know, there's been a lot of industry noise around pricing all across the world, and it's something that we've been very consistent with our strategy, and it's one that consumers are responding to. Over the long term, obviously, we've got a competitor that is posting really strong results, really strong margins. We need to make sure that we lower our costs, especially our structural costs, and we're aggressively getting after that. We announced a $2 billion program. Today, we're talking about being at the high end of that range in 2023, getting about $1 billion out this year, with the other $1 billion to follow next year. And it's just the first step in the process of making sure that we're competitive for the next generation.
Does cost savings mean layoffs?
We're actually not doing any layoffs, Lisa. So we, at the end of the day, we had a voluntary severance program. We had over 5,000 of our colleagues opt either to retire or to move on, and that alone is going to save us about $1 billion in the run rate. And that's something that we think we can manage through and hit our goals on our $2 billion program.
You reported full-year expectations, Paul, that exceeded what a lot of people were anticipating. How much does this hinge on North America and not on China? How much is this completely independent of an international story and very much U.S.-focused?
Well, the bulk of our business is obviously in our North America segment, and we had a really strong quarter there. Pricing is still up as we see wholesale prices are still lapping the increases we had last year that we put through as a result of the higher input costs, and demand still remains strong. So our volumes were up about 4%. Our inventories were flat, and I think the team's doing a very good job of managing through that. We've planned for the year, and we alluded to this in our guidance at the beginning of the year, that we were assuming a 15 million unit market here in the U.S., and we came in slightly above that. But, you know, we've got some cushion built in case we see demand start to fall off in our expectations. But when you look at our first quarter outperformance and the confidence of our cost reduction plan, we felt comfortable raising the guide. Now, China, obviously, is very competitive. They're still coming out of COVID, and we see demand recovering, but it's also an incredibly competitive market. The team there has done a great job. We were able to maintain profitability in Q1, but we think second quarter is going to be a little bit challenging, and then we'll start to see some improvement in the back half of the year.
Given how exposed you are to the U.S. market, Paul, what is your concern level in terms of tightening credit? We talk all about smaller banks and restricting credit on the margins, in particular when it comes to auto lending. Are you seeing that already? How aware are you of that?
We haven't seen that affecting our consumers and our customers. We obviously have a captive financing arm through GM Financial. Their credit statistics, we look at them every week, and they're still quite strong. We've seen a little bit of normalization, but really back to kind of pre-COVID levels, but nothing that we've seen that gives us any area of concern right now for our consumers.
And Paul, you've got a familiarity with Auburn, Alabama. And I see in Auburn there's 62 public charging stations, but only 6 are free EV charging stations. Does General Motors have to provide leadership and set up a grid of electric charging stations across America?
So this is an area that we got out to an early start on, Tom, as we started to build out that network. And we think it's an important piece for EV adoption across the country for sure. But we committed about $750 million to a multi-pronged charging strategy. The leading piece of it was a partnership with Pilot Flying J to help increase the interstate system for road trip charging across the board. But we also partner with our dealers in local communities to locate chargers for those families that may not have one in their home. And really, we feel like we need to provide solutions for everyone across the board. But, paid charging is actually something that's I've found is far more economical than even filling up your car with gas. So it's something that ultimately we're committed to.
What are you going to do on the dividend? I'm absolutely I've been talking about use of cash right now. I got a gross yield of 1%. I'm not even sure what dividend growth is. Describe the 5-year dividend growth forward for General Motors.
So we look at our dividend as an important part of our capital allocation priorities. The first one is obviously investing in the business. We have a lot of capital that we are investing for the transformation, $11 to $13 billion this year alone. But we're still generating really sizable amounts of free cash, and that's a testament to both the team as well as the demand for our products across the board. This past quarter, we repurchased about $365 million of stock, while also early retiring $1.5 billion of debt. So taking care of the balance sheet, being prudent with our capital across the board, and a dividend is a part of that. But we also are actively using share repurchases as a tool to return capital to shareholders.
Have you noticed how much more comfortable CFOs are, Tom, when they beat and race? Yeah. Have you noticed that? Everything's just calmer.
His voice changes.
It's just okay. It's calmer. It's calmer. Paul Jacobson, thank you, sir.
It's a better day for sure.
For sure. General Motors CFO, the stock is up this morning by something like 3%. TK.
I got 8 ways to go here, but I'm going to go to, they're doing the financing of the vehicles and all that. How many people know that General Motors is 71% debt? I don't think we know that. It's not like an equity juggernaut. It's run by debt, and they have to manage it, and that's what Mr. Jacobson does.
Yeah, and they're working at a time when there still is incredible amount of demand for expensive vehicles by wealthy individuals who can pay with cash, and that has been the divergence. How do you cater to those individuals at a time when, on the credit side, you are seeing signs of tightening?
If wealthy individuals can afford it, why are we still subsidizing it at the government level?
For electric vehicles, you mean?
Sure.
Yeah, well, this is a great question. A lot of people are wondering about that.
Sensitive issue.
How do you accelerate the move to EVs at a time when the government isn't more interested? This is one of the big conundrums.
I had the Road and Track headline up there. You go 355 miles in the EV that Paul and Lisa have, and the answer is you got to recharge it. Where's the recharging station when you get to 342 miles?
A lot of people have them in their homes now.
Yeah.
It's like a thing.
It's tough park in the Hummer. It's tough park in the Hummer EV in Manhattan.
You think?
Yeah, Lisa has to deal with it every day.
Oh, I have one.
Today, what are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We're investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Don't know how deep of a economic correction we're going to have. Will it be mild? Will it be more severe?
We believe we're still in a bear market, a mixed market. We think we've seen the worst of it.
The big question here is, what is global growth going to do?
We do think that the second quarter, we definitely will see some negative readings.
Have we pushed out a slow, shallow recession into 2024, or are we going to not get the pickup at the back half of the year that we're looking for?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An exceptionally busy Tuesday in the middle of earnings and on to next week in Apple. We'll do that here in a moment. But the sell side speaks, and John, they speak on FRC this morning.
Yeah, First Republic not doing well in the pre-market, down 22%. Citi had it put under review back in March. The rating was neutral, now cut to sell. The price target's 11 in the pre-market, trading in and around 12. The news from First Republic after the close, just not great at all. If you look at deposits, they plunged 41% in the first quarter. This was the number, 104.5 billion. This was the number that analysts were looking for, 137. That's even after the big banks parked 30 billion there. If you want a glimmer of hope, the good news is that apparently deposits stabilized from the end of the first quarter to where we are right now. But ultimately, if you do an earnings call and you don't take questions after the March that they just had, I don't think many of these analysts are going to be too happy, or investors for that matter as well. And I think we're seeing that reflected, Tom, in the stock, down more than 20%.
Lisa, you wonder how it redounds over to the other smaller banks, not the regionals, not the super regionals, but buffeted by commercial real estate, buffeted by different challenges. I think there's been not a lack of transparency, but just there's an opaqueness to it right
Well,
now.
John had been saying earlier that we've gotten a whole host of regional banks and we haven't gotten any massive surprises. On some level, First Republic kind of was that shock where you saw that it was even worse than people expected and that they really don't have answers to a lot of the very difficult questions that people would have otherwise asked. I mean, what other conclusion could you possibly draw? So this raises an issue of, okay, what about everybody else? Were their earnings really as rock solid as seemed to be represented by the lack of any further declines, sort of like what we saw at First Republic? But today we are seeing them fall in sympathy.
News extraordinary this morning, and we'll do that with the economic data today, particularly on housing. On the data front, John, I'm looking at SPX. I'm just looking at S&P futures, and you know, negative 21, negative 22. Then they come back, and they're vacillating off of weak guidance and also some constructive earnings reports as well.
Yeah, today the price action has been constructive at the index level, particularly on the NASDAQ, because of a handful of names. And you're going to get the earnings from those handful of names starting after the close today, with Google and Microsoft, tomorrow Facebook, Thursday Amazon, next week Apple. The focus shifts, Tom. You know the arc of earnings season starts with the banks, then you move to tech pretty quickly, and we will do later.
We will focus on that this morning.
Because of a handful of names. And you're going to get the earnings from those handful of names starting after the close today, with Google and Microsoft, tomorrow Facebook, Thursday Amazon, next week Apple. The focus shifts, Tom. You know the arc of earnings season starts with the banks, then you move to tech pretty quickly, and we will do later.
We will focus on that this morning. We have a wonderful guest with it that John's going to bring in. But, you know, John, it's going to be important. Neuberger Berman is going to focus today on the 4 p.m. earnings. Thursday on the 4 p.m. earnings. Tomorrow, every set there will be shifted from financial media over to Manchester City. Arsenal.
Are you saying that Charles Cantor won't be watching Meta earnings?
He will not be watching Meta earnings tomorrow. How big a game is that tomorrow that's going to distract global Wall Street?
We call this a six-pointer, don't we, Charles?
Epic.
It's a six-pointer. How big is this for Arsenal, for the Gunners?
It's huge. I was at Highbury when I was 4. So I have a
Were you really?
I really was. My dad was teaching at the London School of Economics, and he dragged me along to Highbury, and I'm super excited about Wednesday. So we'll have the 3 Bloomberg screens going, and one will have the match on, and the rest will have Meta earnings.
I had to say to Tom on Friday when they were throwing the game against Southampton away, I said to Tom, you need to understand the phrase bottling it. Are they bottling it?
They choke in a little. It's tough to lead the whole year from the front, and it's been remarkable, and we'll know tomorrow. We'll know tomorrow.
Top of the league, Arsenal, going up against Manchester City, the top 2, the face down tomorrow. So you won't be watching Meta earnings. I imagine you'll be looking at Google and Microsoft a little bit later. These tech names have had massive moves year to date. Lisa talked about Meta up something like 70 to 80% so far in 2023. Are you expecting the numbers to validate the moves?
I think the 2 stories this afternoon will be a little different. Microsoft's going to be all about Azure and the enterprise slowing, and the large enterprise companies have all kind of looked at their cloud spend and decided to rationalize a little bit. But then on Microsoft, it's going to be telling the long-term story around OpenAI and their 49% investment there. We've done the math on some of that. The math's not easy. You know, the AI market will be over $1 trillion market by 2030, and Microsoft's magnificently positioned there and can add at least maybe 20% to their top line over the next 5 to 6 years. So I think Microsoft is going to be you're going to look through the valley to the next peak, so to speak, kind of ignore the shorter term headwinds and focus more on the longer term opportunity. Where Google, I think they haven't provided the sizzle that Microsoft has as it relates to OpenAI. So I think there we're looking for a lot of clarity around their longer term strategy. I think they're magnificently positioned there as well. But unlike Microsoft, we're going to be thinking through efficiency and optimization as it relates to their cost structure. They sell at 2 vastly different valuations. The point I'd make maybe more generally about technology that maybe sometimes gets lost, by and large, the resiliency you've seen in earnings out of the index, so to speak, is because these businesses have magnificent income statement flexibility. And the challenge with the financial companies is they don't have income statement flexibility. They are tied by their balance sheets. And so I am quite optimistic that the very large index contributors will deliver earnings that are of high quality, and they're protecting their cash flows this year. The market shifted, as you know, from revenue to what matters, which is cash in the bank.
Which they have magnificently displayed. Will OpenAI be the new blockchain? I mean, basically, have we already fully priced in just saying Chat GPT and then seeing your stocks soar?
I don't think we have, and I certainly haven't at Microsoft, and we certainly haven't at Google, because Google sells at 10 times EV to enterprise value. That is not a valuation that suggests a lot of good news is priced in. I like the analogy to blockchain. We think the efficiency opportunity for people that adopt AI is 2x on the margin line relative to the blockchain. So we're talking, if you thought blockchain was a 200 basis points improvement to efficiency for companies adopting it, we think OpenAI is probably 500 basis points. Think through the efficiency of that and think through the productivity.
I want to focus on your courage to own a few things, owning big. You were down, I believe, 24% last year in one portfolio. And maybe that was a little worse than others because you had big tech owning. I want to talk about the street focus on that these stocks are too big, too dominant, and people are diversifying away. Peter Lynch called it diversification. In general, are people diversifying away where they should own more of big tech?
It's a big question we have. The growth strategy, our large cap growth strategy that was down 24% last year, we felt great relative to the large cap growth indices. I think it proved out the high quality defensive nature of how we proceed with growth. I think I gave you the analogy with Microsoft. Here's a company that can add 20 to $30 billion to their revenues over the next 5 years, and they're running at $200 billion of revenue today. I don't know many companies that can operate at that scale with that type of opportunity. And I think when you think through Google, the challenge there is going to be, it's a little bit of the innovator's dilemma. Can they understand the threat that AI provides to their core search business, which is kind of a 92% monopoly business, while capturing the opportunity of AI? Not different to how Netflix kind of attacked themselves as they went from physical delivery of content to digital. And you've got to factor in valuation. Look, in this environment, I think you got to quality up. You got to own income statement flexibility. You got to be mindful of the balance sheet, and you got to own businesses that, if the tide was to go out, you feel really good about their next 3 to 5 year positioning. And I think you just find that today in the large companies that are going to be massive beneficiaries of all the compute spend that's going to take place with AI. Microsoft's magnificently positioned. So is Google. So is Amazon. So is Meta. These folks own the largest computers in the world, and they're going to rent them out to everyone else, and everyone else is going to enjoy a 500 basis point margin improvement over time. And that's going to be very good for the economy. It's going to come with lots of headwinds, no doubt, lots of regulatory scrutiny for sure. But net, it's massive.
I didn't hear LVMH or Hermes. Up in quality, that's all we're hearing about. Europe, luxury players, all of that good stuff. Why are you not there?
We're not there necessarily with that specific wonderful high-end retailer. My wife's there in spades.
I'm sure.
In spades. We were recently in Europe, and there is a currency hedge, currency arbitrage, so to speak. So I'm familiar with the power of that brand. They've built a remarkable company. They've got to go through they've got to figure out which of the 5 favorite kids are going to run the show. But I think this morning from Pepsi and McDonald's, you saw what quality and innovation and convenience and value delivers to the consumer.
Only Charles Cantor can segue from Louis Vuitton
to sell the other half, Pepsi and McDonald's.
I know less about McDonald's as a
quality
consumer.
for both, all of that, right?
But it's just quality, and so
LVMH, McDonald's.
It's a function of who the consumer is. I mean, the consumer at McDonald's sees tremendous value, as does the LVMH customer in a different way.
You were acclaimed on Whole Foods, Amazon. Whole Foods is now thrown in the towel. They're going to go low price, lower price. Is it going to work?
I don't know if they're going to do that precisely. In your honor, I was back there on Saturday just buying a few things for dinner. Look, they have made wholesome food affordable for all of America. You know, what gets lost with Amazon is they now have relationships with 3,000 local producers. That's way up from when Whole Foods was a standalone company. And if you're a Prime member, you're getting value with Whole Foods.
So you were Dior too.
I don't know about you, but when I go into Whole Foods to get dinner, I could have bought a Hermes scarf, you know, given how expensive they are.
It's not perfectly cheap, but it hasn't come down that much
kind.
relative to
I've
when
got
it
15
was.
seconds.
You pay for quality.
Do you miss Highbury?
I do miss Highbury, and I haven't yet been to Emirates. So
been to the Emirates a couple of times.
My guess is the seating at the Emirates is a little bit more comfortable than Highbury.
It's on those old stadiums. I think of Fenway and Boston.
Yeah, Wrigley.
You know, just the romance of it.
It's great.
I wish they'd kept them.
Maybe Charles Cantor can talk to Mr. Levy. Cantor's got the mass to help Tottenham
parachute in and
run
consult. Spurs. I'm not sure Spurs are quality right now, Tom.
Well, that's a
Charles
big debate.
Cantor, thank you, sir.
Great to see everyone. So
Equity futures negative 0.5%. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. In the news this morning, President Biden asking voters to let him, quote, finish this job. The president has formally announced that he would seek re-election next year. In a video released today, he said there is still work to do to give Americans a fair shot. The president criticized what he called extremists in the Republican Party who want to cut government spending and curb abortion rights. House Speaker Kevin McCarthy is refusing requests from fellow Republicans to change his $1.5 trillion debt ceiling proposal. Bloomberg's learned the bill will be sent to the floor for a vote this week under a rule that does not allow amendments. If as few as 5 Republicans oppose the measure, it would be defeated. Halliburton posted its strongest first quarter profit in more than a decade. The world's biggest provider of fracking services said the outlook for oil drilling is bright. That's the opposite of its rivals who predict an imminent slowdown. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
BOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is the BOK is getting ready to make.
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's
going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We still like the tech sector because certainly the understanding that there's a lot of inventory to be worked off. The question is, can they have decent results and the markets really go down because of that? We think we'd rather ride that out and say these companies have long-term growth, they have good positions in their industry, strong balance sheets to withstand, even if we do have a deep recession.
Looking ahead to big tech after the close, that was Margaret Vitale of Allspring Global Investments. Looking ahead to Google, Microsoft a little bit later on this evening after the closing bell in New York. Then on to Meta tomorrow, on to Thursday to Amazon, on to next week on May 4th. Apple earnings just around the corner. Going into all of that, your equity market negative 0.4% on the S&P 500. I've said once, and then I'm repeating a promo that you might have heard a few times, that there hasn't been a shocker yet until maybe, as Lisa indicated, maybe that shocker came after the close from somewhere that it should have been expected to come from. First Republic is down by 22% in the pre-market. Deposits, to see deposits plunging 41% in the first quarter, and so much of that seemingly coming in the month of March. To see analysts looking for a number close to 140 and Lisa getting a number close to $100 billion in deposits, that's a major disappointment for this bank.
That's putting it mildly. The fact that they didn't, as you both pointed out, take any questions in the press conference at a time when people are wondering about the future of this bank, whether it's viable even as a standalone entity, tells you volumes. How much does this really speak, though, to the fundamental challenge for regional banks that has not fully been priced in? That's what a lot of people think. This idea that they're going to have to pay up for deposits. They don't have those cheap deposits. They're going to have to withdraw some loans. And oh, by the way, their earnings are not going to be particularly positive.
I'm going to parse the 22 banks of the Keefe, Bruyette, and Woods index here, the BKX index. You mentioned the regionals, Lisa. There's super regionals, there's small banks across this nation, and then there's marketing plans. And I don't bunch First Republic with any of those other banks. It was a marketing concept run awry when interest rates went up. I just don't, they're not a regional to me.
There's an issue with respect to idiosyncratic risk and a question about the management teams of some of these banks. And then there's this issue of free money is over. Deposits that were cheap are no longer. And so all of a sudden, you have to figure out a new value proposition for firms that benefited during an era where that was just a given, that kind of cheap finance.
I would suggest out of 3M, the new value proposition is cut costs.
6,000 jobs to go there, yeah.
And we saw it with FRC as well. As we lean forward with Charles Cantor here of Neuberger Berman, we do better with RBC Capital Markets, Rishi Jaluria. Now, he's a software equity analyst. Forget about it. Expert on Microsoft. Here we go, folks, on the big stock you don't own. Rishi, 26% per year total return over the last 10 years. The free cash flow blowout pre-pandemic is absolutely stunning. I mean, the cash flow growth out 5 years to a model 2024 is off the chart. Is the story priced into the stock now, or will there be constructive surprises forward?
Yeah, thanks so much for having me. I think the big story around Microsoft, if we put maybe the near-term macro aside, is really AI. And as we've outlined, we really think the opportunity with generative AI for Microsoft is a call option on the stock. It is not priced in today. We actually need to make money off Microsoft stock absent any AI story, but really that's where you get the next leg of growth up. And I do not think that's priced in. If you think about all the different ways throughout Microsoft's portfolio that it can benefit from generative AI, be it in Azure from their agreement with OpenAI, be it competitively with the Microsoft 365 suite and the integration of Copilot throughout, be it in their security, be it in GitHub. I think there's so many ways Microsoft can benefit from generative AI, and I think that's the next leg of growth up here.
Rishi, I want to go to that. Okay, the free cash flow numbers, folks, is $38 billion pre-pandemic, and they went out to $73 billion, modeled out for 224. That's the existing company with 200,000 employees. Rishi, explain how AI is different than other new things, the bright, shiny new concept, and that it's a call option on Microsoft that has real durability.
Yeah, I mean, look, this is the fourth big technological change in my lifetime, right? Going back to the internet, going back to mobility, the cloud, and now AI. And, I know we've been talking about AI for so long, but ChatGPT was that watershed moment that gets AI widespread throughout the ecosystem. This is like when Netscape for the internet came out, or the iPhone for mobility. And that is where we really think this has so much potential, not just for revenue, but to your point on the bottom line for free cash flow for Microsoft, that we can see that number continue to move up. And because of Microsoft's first mover advantage, because of how far ahead of others OpenAI is, and because of how quickly every other company is having to move to have a generative AI strategy, we believe Microsoft will be an outsized beneficiary of that. And if you look out throughout the entire portfolio of Microsoft's products, all the growth rates will be significantly different. Everyone's going to be talking about Azure growth rates, and it's realistic to me that that's going to decelerate to probably 20% growth over the coming quarters. But once you start layering in the benefits from generative AI, because this is so much more resource intensive, not to mention you'll probably have an entire $1 trillion economy built on OpenAI, just like you had a $1 trillion economy with the iPhone and a $1 trillion economy with AWS. I think that Azure number goes back above 30% growth.
Rishi, how much smaller can some of these big tech companies be on a headcount level based on some of the efficiencies that everyone keeps talking about with artificial intelligence?
Yeah, I think that's a great question. I would say, number one for Microsoft, I think in contrast to a lot of the other big tech, they didn't overhire at the same rate. I know they have done a RIF. Some of that was eliminating underperforming employees. Some of that was actual cost savings and reallocating of employees. But I'd say Microsoft maybe had more responsible hiring practices than a lot of other big tech companies that have had to do significantly bigger RIFs. And if you benchmark their employee efficiency relative to other companies' enterprise software, they were very high even prior to the RIF. Now, in terms of the cost savings from generative AI, I think that's a big open-ended question. We can talk about innovation and what generative AI brings there, but there is also, it makes developers significantly more effective. It makes marketers more effective, salespeople more effective. And I wouldn't be surprised if we could see a company be able to get away with significantly lower headcount. I'm talking double digit, right? 10% plus lower headcount as a result of really embracing and leveraging generative AI on the back end. That's maybe more of a 3-year story than a near-term one, but absolutely every company I talk to is trying to use generative AI for greater operational efficiency. And then I think the terminal margins across enterprise software and really across big tech has to be higher long-term now because of this.
Just real quick here, who's going to win the generative AI game? Will it be Google or will it be Microsoft?
It's early to tell, but I think Microsoft has such a huge lead from their early investment in OpenAI, from the fact that OpenAI is an arm's length transaction. You look at the advantages you have in ChatGPT versus all the other systems out there, including Bard and Claude and any others that have been out there. I think Microsoft has a huge advantage and it's theirs to lose.
Rishi, great to get your perspective on a key story a little bit later on this afternoon. Rishi Jaluri there of RBC. TK, you know the history of this. It has been amazing to see what Microsoft has become over the last 20 years.
My brother has a hard drive from Sun Microsystems 40 years ago nailed to a wall of his house out in Utah. This is what he said the other day. ChatGPT and AI is game-changing like nothing in 30 years. He's in the trenches of this, writing code, doing what Rishi's talking about. I was stunned when I heard that. He's not one to say that.
I was looking at a study that showed the top professions that would be replaced by ChatGPT and OpenAI, and I think journalist was number 45. So I think of 700.
He's
so
talking
I was saying
about,
to myself, okay, that's good. I've got a couple
let's
more
meld
years.
what we just heard from Rishi with Charles Cantor. Cantor's talking about a 200 to 500 beep pickup in margin. And what my brother's saying, the electrical engineer, is it's the grind of coding is where you see those efficiencies, not like what's it going to do to journalists or, English football players.
We're all learning about the difference between you and your brother.
Oh, yeah.
Every day, Tom.
Straight A's.
I've never seen this before.
No, it's like, seriously, the difference between me and my brother, straight A's, not.
Coming up next hour, Keith Lerner, Luke Hickmore, Katie Kaminsky.
Trends in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Surveillance. Good morning, everyone. Lisa Abramowitz and Tom King. John Farrell preparing for the next eventful hour into these tech earnings. Just great. Lisa, I thought it was great to have Charles Cantor and Rishi there from RBC Capital Markets back to back on the ginormousness of all these stocks we wish we owned more of.
Well, exactly. I mean, this idea that there's going to be a sea change in technology that's going to generate massive growth, massive investment, massive efficiency in ChatGPT or the broader open AI kind of infrastructure. This doesn't really pair with this sort of moody, gloomy feel of an economy destined for recession. And so pair those ideas as sort of the preeminence of certain technologies with an underlying fear of a softening of the consumer.
I mean, and again, the softening here, and David Rosenberg had it with a tweet as we go to our next wonderful guest here about this, the quality of our economics in the first quarter and what it means for strategy with futures at -17. Laura Rame right now, Chief U.S. Economist, FS Investments. A lot of people, Laura, including Mr. Rosenberg, are talking about how January was bang up and we're already into our economic slowdown. We hear that within the guidance of corporate earnings, selected guidance, I should say. Are we into our slowdown?
We're still in a slower growth environment. And I say that only because remember that outside of the pandemic boom or post-pandemic boom, our potential growth rate is around 1 3/4. I think that's where we're settling, 1.5 in the second quarter. And the consumer still has so much momentum behind it. You look at the fact that, yes, the wealth drawdown, the savings drawdown continues. But I think if we've seen anything, it's that deposit levels broadly are still relatively high. And that means that with jobs still broadly plentiful, outside of tech, I want to be clear, there have been some distressing layoff announcements, but jobs remain plentiful. It's what we're looking at the most closely, but right now it's way too soon to call for a recession.
This idea of a recession, if I get a growth rate, and I want you to give me your growth rate for it, if it's under 2%, to me that's germane. If we have a 1% or 1.4% all bundled in growth rate, isn't that a recession for a lot of Americans?
It doesn't feel good. One of the big conversations that we're having is the fact that we're seeing sluggish growth rates, but still really significant and robust job ads. And most of those new jobs are going to still these sort of lower productivity service sector jobs. I think productivity is extremely low right now, and that's what makes it feel like such a grind. But this is really the difference between sluggish growth. We've had plenty of periods Remember 2015, 16, we basically had an earnings recession, but we didn't have a growth recession. You get periods of sluggish growth that don't check all the boxes of recession. It doesn't mean they're great, and it doesn't mean that they're easy investing landscapes. I think you bring up a really important point about the forward guidance we're getting from companies. Earnings estimates going forward are still flat. I mean, they've come down a lot, but the forward 12-month is still at net flat. That's not a recessionary outlook. In recessions, earnings historically fall 10% at least.
I'm struck by everyone talking about this bifurcation or just splintering in terms of the fates of different sectors. And you were kind of, before we got on air, talking about this as an 18-wheeler and the Fed's just pumping the brakes on 2 of the wheels and then everything else keeps grinding along. And I wonder if we're going to look back, yes, as a grind when it comes to just growth numbers overall, but a real transition moment for this economy where it sort of accelerates the gap between the haves and the have-nots, whether it's individuals or whether it's companies, the large ones with pricing power, those that are going to get subsumed or go out of business. How much are we at a tipping point that will rearrange the structure of this economy?
I think, Elisa, I think we're already there. I think if you look at the share of capital going to labor, it's actually already increased. We've already seen globalization really wipe that out significantly, and we've bounced pretty significantly. I think when you look at the breadth of the market rally that we've seen, it's so narrow, and it's so narrowly focused on these large cap tech companies. It makes the pressure on the earnings this coming week very acute. And I think beyond that, look at the whole issue that the Fed is having with inflation. The wages that the historically sort of commoditized service industry is able to garner is really rising. It's not necessarily good for profits going forward, but I think we have to acknowledge that maybe we had kind of stretched the rubber band of inequality so much that it is rebounding to some degree. I don't think that's all bad.
The creative destruction, Lisa, I thought your question was just brilliant. Let's go back a few years, think 1982, 1970, Dow Jones Industrial Average, the Westinghouse Electric Corporation, a company called Eastman Kodak Company, Union Carbide, Inco Limited, and others, Goodyear Tire. I mean, I think what you brilliantly asked about in the superiority of technology is just American corporate history. It's just that simple.
I would agree. And pair that with the sort of right sizing of imbalances that have been created over all of this time. Laura, you mentioned how a lot of lower wage workers kind of getting more power in a sense, that the power is shifting back to labor to demand more for their services. We got the results from McDonald's. We got the results from PepsiCo and Coca-Cola. And we can see that actually they are still able to pass along the price increases to consumers. How much is this a story that runs out of time? And how much is this possible because of that power of labor, a basic stickiness to an ability to pay more?
Well, and I think add on to that the fact that when we look at these companies, the big tech companies right now, they're growing by expanding into each other's lanes for the first time in a long while. They're very mature companies. And, unlike before where it was only focused on growth, I think now they're having to kind of cannibalize each other as they grow. And, Lisa, to your point, the data point this week that I think is garnering so much attention for me is initial claims. We've seen the tech layoffs. Let's see how it expands to the broader economy. Because right now, I hear companies we're still working to retain labor, not just blanket looking to shed.
Laura, more than any other chief U.S. economist I know, you've enjoyed the trenches of foreign exchange study. How does a dollar fit into the dynamics to 2024? Weak dollar, strong dollar? Do we overestimate dollar movement?
I think a lot of people right now are watching closely to see if the dollar weakens further from here. It's weakened significantly over the last year, but still, if you look at a long run view, it's relatively strong. I think that the humdrum around the dollar's weaker status as a reserve currency is getting a lot of attention. And to me, that's one of the unspoken background stories of the strategic chess match, which is going on right now globally.
So what is your run rate for GDP? I mean, 12 months out, all in GDP. I think it's something our audience, with all the narratives Lisa's talked about, we've really lost scale of. What is your statistic for real GDP out 12 months?
1% growth over entirety of 2023. I think we hit negative 0.5% in the third quarter, negative 1.5% in the first quarter, and then we bounce from there. I think it is a recession, but I do think it is more mild, and that's because these big companies are needing to invest.
When you talk about some of the larger companies cannibalizing from each other, do you think that we're going to get, I know that Tom always talks about monopsony, are we going to get basically oligarchies in every industry? Yeah. Is that going to be how we emerge from this period?
I mean, I think you could argue that we're already there, but it is something that America does well. It's destroy our oligarchs. I think, I remember 15 years ago, we just talked about Walmart and how every single earnings cycle, they just got bigger and bigger and bigger. And then Amazon came along. I mean, look back at history. It's rife with companies that really expand and blow our minds with innovation. And then 20 years later, they've been toppled by the next new thing. So, are these the companies that are able to innovate and stay ahead of that? I think they're great companies. I just think that they're trading at their PE ratios are too high right now.
So as Tom mentioned, I've been a little bit all over the place today. I've been really interested in a number of different themes. And we keep going back to the one that's underpinning so much of what's going on economically, which is inflation. And we kind of hinted at it with respect to labor's power. And when is that going to wane? When we emerge from this, will it be to a higher inflationary regime based on that shift back to labor?
I'm going to add more nuance and say that I think we end the year with inflation that's uncomfortably high, around 4%. But I do think that, of course, we will face periods of lower inflation. I think that the 25-year low inflation, low volatility inflation episode is over. And going forward, we're in a period of higher volatility inflation, less ability to control inflation through globalization. And I think it implies more volatile monetary policy cycles.
Laura Ram, thank you so much. With FS Investments. Lisa, as the president was announcing his reelection, the head of IR for Pepsi-Cola was going, how dare he do that? Out came Pepsi the moment President Biden talked about a reelection attempt. I don't think we gave it enough love. Forget about 12% organic revenue. Frito-Lay, this is potato chips.
Thank you. I'm fully aware. I have
up 16% organic revenue growth. Joe Weisenthal of Odd Lots makes the a statement here. It's all about pricing power, which Jack Welch never dreamed of.
They can raise prices. We talked yesterday about shrinkflation, shrink the amount that you actually get and continue to sell. And this really raises this conundrum. Where is that weakness? If you can see Pepsi with their pricing power, you see McDonald's with their pricing power, you see Coca-Cola with their pricing power. Charles Cantor talking about quality and how there is quality there for the consumer in each sector. But to me, how long can they continue to do this?
Well, that's the question. It's an arch question, and the optimist would say Apple, Microsoft, PepsiCo, whatever, they can continue to do it. What's fascinating here, and this goes back to, some people are alluding back to the nifty 50 of the 60s and that. To your point on monopoly and this odd thing, monopsony, which is a different concept, those two ideas lead to concentration. And I wonder if the theme a year from now or 2 years from now is just going to be mass concentration of selected successful companies. I wonder if that's where we're heading to.
And Laura was saying we're already there. That's what you're seeing right now. So what about that zombie roll-up, right? When do we see the others sort of taken out of business? And that, I think, we're starting to see. I mean, the fact that Bed Bath & Beyond is closing all of their stores, the fact that David's Bridal will close all of their stores if they don't find a buyer. This isn't just a restructuring and a repackaging. This is a change.
And Manus Cranny would say Credit Suisse is closing all of their stores. That may not be accurate, but there's different zombies out there. There's different roll-ups. What a fascinating time. On Washington, Henrietta Trey's next. Futures at -17. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Joe Biden has made it official. He's running for re-election next year. The president made his long-awaited announcement in a video today asking voters to let him, quote, finish this job. He'll face a Republican field dominated by his predecessor. Meanwhile, economic uncertainty will cloud his case for a second term. Meanwhile, the British government is set to unveil new legislation that could lead to a crackdown on Silicon Valley. Big tech firms such as Google and Meta Platforms face more oversight and fines of up to 10% of global sales for practices that hurt consumers. The legislation would create a digital markets unit in the UK's antitrust regulator. JetBlue reported first quarter operating revenue that met estimates. The carrier also reaffirmed its fiscal year earnings outlook. JetBlue says that in the second quarter, it expects strong revenue growth to continue thanks to robust demand. And General Electric posted first quarter sales profit and cash flow that was better than expected. The company also raised its annual guidance thanks to surging aerospace demand. GE wants to more than double earnings this year before separating its energy-related business.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's a terribly stressful job, as you know, and the fact that he could still be president at the age of 86, to me, is mind-boggling. But it's worth noting that Donald Trump turns 77 later this spring, so it's not as if it's just one old candidate, it's two old candidates.
It's 6 a.m. this morning. Gregory Valliere of AGF Investments really writing on. People go, who's Greg Valliere? Why is he on? And the answer is he puts out a brilliant short note. It depends, 4 or 5 a.m. hour, maybe the 7 a.m. hour as well. And Lisa, there's other notes like it, but he just brings in the business and finance sector into the Beltway. Like nobody does it like that.
And right now, that's going to be needed more than ever at a time of such uncertainty with the economy. We were talking just then with Laura Rame about all of the strength in the economy, and then we got this data point about the Philadelphia Fed non-manufacturing activity for the month of April. It came in way below expectations following on what we saw from the Dallas Fed yesterday. So this speaks to the other side of the story, and this really speaks to the politics of a moment when how do you get reelected in an economy that's not going gangbusters?
Yeah, John from Milani emails in, and he notes that the market moved here 2s, 10s with some movement. Real yield doesn't move much, but the 2-year yield 4.03%. You wonder, do we get a 2-year under 4% again? And I mean, we're swinging back, maybe given earnings guidance as well, to that kind of slowdown.
But you also wonder how much volume is and how jittery people are for the Philadelphia Fed non-manufacturing activity survey for April to be moving yields this much, Tom.
Well, it's going to be more economic data as well, and we'll have that through the morning new home sales here, 10 o'clock, leading the way with those mortgage rates. Henrietta Trey's with us right now, Director of Economic Policy Research at Veta Partners, but far more political economic policy as well. When an election starts 560 days out, Henrietta, what's the gridlock look like? What is the new gridlock after the election is engaged?
The new gridlock is basically we get this debt ceiling past us, hopefully in the next month or two, and then we move pretty much exclusively to China. And there will be a focus on trying to craft a bipartisan bill, any attempt to differentiate the Republicans from the Democrats on that front. And I suspect they'll both be jawboning about what could come on the China front, including tariffs, investment restrictions heading into P7. That's what we'll be.
So that'll be the legislative debate. But does China fold into election results? The maxim I've always heard is that domestic issues are far more important in an election dash. Does China play into the election dash?
I think so. You have nearly 80% of the U.S. population who believes that China is something of an enemy to the United States. So it's a very popular boogeyman. I think you have to question what the underlying macroeconomic data is going to look like. What's unemployment? You know, if it's still in the 3.5%, even 4% range, it's not going to be that striking topic like it has been in years past, and we were at 8, 9, 10%. If inflation has come down and it similarly is not in the 8, 9, 10% range, you're going to have an opportunity to focus on foreign policy because domestic politics or domestic economic policy data will have a cooler temperature. It won't be big enough to occupy headlines every single day. So you can have an opening for China to be a conversation.
A lot of shift right now when it comes to geopolitics, a lot of shift when it comes to economics, and there's not a lot of shift when it comes to the most likely matchup for the 2024 election. It is President Biden. He is in the running. That is what he said earlier this morning with the official announcement. And former President Trump, this is the likely matchup. What does that say to you, that it's the two known entities going at it again?
You know, it's really interesting. I'm trying to find a great way to say this, but as an analyst, you know, we're always looking for some sort of nuance or edge to share with clients and help them have a little bit of extra juice going into any kind of a big event like this. But realistically, we have a pretty solid run rate to work with. Democrats won the midterm elections in 2018 by an overwhelming majority. Democrats won the 2020 presidential election, picking up Arizona and Nevada. Georgia even. We won the special elections in Georgia twice. And then in 2022, ran in a super high inflationary environment coming out of the pandemic in a race that Democrats had no business winning. And the minority party lost in the most epic blowout since the 1930s. So it's really difficult to try to find a rationale for not knowing the outcome of the 2024 presidential election cycle. We've seen this fight literally 4 times now, and each one ends the same way. So it's difficult to find a way to explain or convince anybody, including my own brain, about how you could see Republicans win in this environment with the same candidate.
How much is this Democrats winning and how much is this Republicans losing with respect to where the balance of power is in that party?
I would definitely look at the key states. I mean, all our clients know, and y'all know, it doesn't matter what the national data is. It's really about key states on the Electoral College. So look at Arizona, look at Pennsylvania. In those states, Joe Biden is ahead by 4 points, 1 point, and that's the outcome.
Twice today, a question of progressives or liberals within the Democratic Party. I mean, in the Republican concept, there's this idea Republican in name only. Is Joe Biden a Democrat in name only?
I think that if you were to poll a Bernie Sanders or some of his supporters, they would say things along those lines. But it's really difficult to look at the track record and see a $1.9 trillion CARES Act bill passed in the first month of his administration, the CHIPS Act, which was bipartisan, the bipartisan infrastructure bill, and then the Inflation Reduction Act. There is establishment, Democratic, Democratic in name only agenda items like CHIPS and the. But then there's also those progressive items, green energy tax credits that are very expansive. And then obviously the $1.9 trillion COVID relief bill, which had a lot of progressive agenda items in there. So you can make both cases.
Thank you so much. Henrietta Trey's, Director of Economic Policy, Veta Partners there. We've got to run because the news flow today is just extraordinary. I mean, you and Lisa, you did such a good job on the earnings, and they're like, am I right? McDonald's thumb up, UPS thumb down. I mean, it's that variance.
It's that binary in terms of what industry you're in as well. If it's physical stuff, it's harder, right? That's what we're finding. UPS, whether it's 3M, yes, their shares are up a little bit, but they're cutting 6,000 jobs. If it's stuff that you buy to eat or drink or go out and do, whether it's airlines, whether it's McDonald's, that's doing well. And this is sort of how long can we continue in this sort of motley progression?
We're trying to continue to the surveillance nap or to Manchester City Arsenal tomorrow, and I don't know if FRC is going to participate. It is plunging, folks. That is, I rarely use that word, but on an intraday chart, we are at 1280, 1260, and we're doing a free fall now down under 12 to 11.88. And suddenly, and I do with respect to all the challenge they're facing, and we don't want to be inflammatory, the sell side is voting. I saw Janney Montgomery Scott, Citigroup adjusting. Everyone seems to be adjusting. How do they get to 4 o'clock this afternoon? Help me.
It's a real question, and people are wondering who's going to come in and be the white knight at a time when a lot of people don't want to buy it. I will point out that PacWest, which is going to report earnings today at 4:20 p.m. Eastern, free money is not free, and those deposits cost a lot more, potentially even more than if you were a big bank.
But there's other banks the same size that are relatively doing fine. It may be a changed environment, net interest margin dynamics, and in commercial real estate and that. But to me, and I don't know, what is it, Pacific what?
Yeah.
Western
PacWest.
Alliance?
Yeah, Western Alliance,
Pacific
PacWest.
West, and the other names. They're different than these other banks, is what I would respectfully suggest.
Sure, there are definitely idiosyncratic stories within the larger sector. The bigger economic picture, though, is that something has to give. You have to see some loans being pulled back in order to deal with a different funding structure. So, yes, perhaps not Armageddon. These are not necessarily representative, but there is a broader story here that affects more firms.
They got 5.3 million shares of FRC trading. The bid, we just popped off 11.86 on FRC. So I think that's a story truly to watch. I mean, how did their executives react? We didn't hear from them yesterday in a conference call. Did they redux it today with some form of statement, and even as soon as this morning?
You know what I'm guessing? I'm guessing they're on the phone right now. They're on the phone, 1-800 Jamie, 1-800, going around finding out. Anyone?
Anybody going to pick up the phone?
Yeah.
I'm not sure this time around. Extraordinary day, and really gives you a flavor of it through the week and onto the Apple earnings on May 4th after that Fed meeting. Microsoft this afternoon. This is Bloomberg Surveillance.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
You're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, you know, proximity is going to be key.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
First Republic getting hammered in the pre-market. Equity futures negative 0.5%. Live from New York City. Good morning, good morning. We're softer here going into the open. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up. First Republic results sending the stock much lower. President Biden finally announcing his re-election bid and looking ahead to big tech reporting after the close. We begin with the big issue, some cracks in the calm.
We're still relatively cautious.
We're always looking towards what the next shoe to drop will be.
And what's happening underneath on some of the things because of these regional banks.
For First Republic, they're going to reduce the workforce 20 to 25%. That makes sense.
They have really struggled clearly for the quarter.
Many of these deposits has flowed to the large banks. Clearly, if you continue to have a lot of outflows.
And they need to do something. They either need to shrink the balance sheet or they need to find a buyer.
When you look at, again, the regulatory environment for the regionals, it's evolving.
In the U.S., it's not just about one bank. It's about actually a whole type or a whole category of banks.
You are starting to see an economic slowdown.
The real question is credit really going to be much tighter?
I think that is something that the Fed needs to watch carefully.
There's still some pain to come, we think.
Some pain to come. Let's start the conversation with Aberdeen's Luke Hickmore, Keith Lerner of Truist. Gents, great to catch up with you going into the opening bow. Keith, your line, you nailed it. Are things resilient or complacent?
Yeah, well, great to be with you, Jonathan. I mean, that is the question, right? If you look at the headline, the popular averages, I think the answer would be resilient because we're up 8% this year. But as you peel back the onion and you look underneath the surface, I think you see less resiliency. In fact, the average stock this year is up, 2 or 3%. We all know the story. The big cap tech names are up like 20% on average. And then as you look, if you think of this as, there's a lot of debate, are we in a new bull market or not? In a new bull market, you typically don't see small caps making relative lows or financials leading to the downside. So overall, we remain defensive. We think the risk reward is less attractive at these levels today, and we're being patient.
Luke, this builds on a conversation we've had throughout the whole of the morning so far. It's whether this tight, well-behaved trading range of 3,800 to 4,200 on the S&P so far year to date, the minimal moves we've seen last week, muted price action month to date, masks something more sinister developing. Where'd you come down on that particular debate at the moment, Luke?
I kind of agree with Keith. I'm not sure it's an onion, though. I think there's an issue here that inflation's going to be coming down. It's going to pull down revenues. And I don't think we've really seen people adjust their EPS forecast enough for the change in the environment that we're going to see for the rest of the year. I think equities are too high here.
Is that for the tech story specifically, Luke?
I guess tech might actually get a little bit of support. If you think of tech as a long duration equity, thinking in bond speak like I do, and yields are coming down and interest rates will fall late this year, early next, maybe some support. But, they're going to get carried around with the rest of equity markets as well, which are just too high at the moment to support where we see earnings going.
Google, Microsoft after the close onto Wednesday, Meta, Thursday, Amazon next week, Apple on May 4th. All of this, a big, big chunk of the market cap of the S&P 500 over the next week or so. Keith Lerner, a question I keep leaning on over the last 24 hours or so. Keith, the moves we've had year to date, will they be validated by the numbers from these companies?
Yeah. Well, I think, Jonathan, I think Louis Rukeyser said, don't make a prediction where you could be wrong in 24 hours. But even with that, I'll still take a guess. I think the earnings will come in relatively well. I think the challenge for this overall market is, tech is the main reason why this market's up this year. And actually, if you look at the S&P 500, only about 30% of stocks within the S&P 500 are actually being the index, and that's tech-driven. But now you're at about a 30% premium for the technology sector. A lot of good news is priced in. We still expect them to outperform on a relative basis, but we're not overly excited about the group on its own, and that's why our overall market view is somewhat muted. Because let's talk about tech. The technology sector itself. Two stocks, Microsoft and Apple, account for over 50% of that index and about 14 to 15% of the S&P itself. They're both trading around the 26 multiple at the high end of the historical range. So I think on a relative basis, they'll do fine, but I don't know how much upside there is in tech to really drag this market higher, given the one that we've seen year to date already.
Year to date, Meta up 77%, Microsoft up 17% there, Alphabet, Amazon in and around 20% higher for the year so far. Let's talk about something that's been absolutely battered year to date. Let's talk about the financials. First Republic right now in the pre-market, down 26%. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, this is said to be the biggest drop in over a month, and really this is all about deposits. In results the bank posted yesterday, we saw a 41% drop in deposits, down to $104 billion at the end of the first quarter. That was well short of analyst expectations and signifies a $72 billion drop in deposits quarter over quarter. That's even with a $30 billion deposit infusion from larger banks last month to try to stabilize the bank. Clearly, though, this bank is still struggling. Aside from the deposit picture, it had a 19% drop in net interest income. It's getting squeezed by higher funding costs, and so the bank is looking to make some changes. They are going to cut 20 to 25% of their workforce in the current period, try to moderate loan volumes as well, reduce the size of the balance sheet. And they also said on a call in which they took no questions, mind you, in this earnings call, that they are exploring strategic options. Now, Bloomberg has previously reported they've considered a sale of the entire bank, but its sizable unrealized losses have caused some buyers to balk at the prospect. So the future of this bank in many ways remains uncertain. In the meantime, though, the shares just getting put under more intense pressure. Already it was down 87% year to date through yesterday's close. Those losses, of course, building in a big way this morning. This was a $121 stock at the start of this year. Currently in pre-market trading, we're south of $12, John.
Back to 11. Kaylee, thank you. 11 on First Republic. I think Citi came out with a call earlier this morning to cut this stock to a sell with a price target of 11. We're there right now. Look at the deposit numbers. Katie went through them. I'll go through them again. Analysts were looking for 137 billion. They got 104.5. These numbers, even with 30 billion coming from some big banks parking some big money at this institution. The good news is the deposits apparently have stabilized since the quarter ended. The bad news, Keith, when someone holds an earnings call after a month like the month they had, and they don't take questions, where does that leave you thinking about this situation?
Well, I think in general, when you don't have an earnings call, people think of the worst, whether that's the reality or not. But I think the big picture is we actually downgraded financials last Friday based on the bounce. We had a nice bounce off the low, about 7%. And our view is, first of all, financials tend to be a leader into an economic downturn and out of the economic downturn. In our view, financials, the risk reward is unfavorable. You have a slowing economy. You have the funding costs obviously going higher, so earnings are going to be pressured for some time. So we think in general, at best, they're likely dead money, but likely to underperform the overall market. And I think the bigger picture is the whole thing about deposit flows and so forth, that seems to have stabilized. I think the next step is that we're going to see the pullback in credit lead to a weaker economy, which will eventually work into those lower earnings that we expect in the back half of the year.
Can we avoid the credit crunch? That's still the open debate. Luke, I'm looking at some of your notes that you've put out. You are firmly in the US recession camp. Luke, why is that?
I think exactly this point about a credit crunch is going on. It's reducing inflation, those falling revenue numbers, lower nominal growth, and still consumers suffering from wages just not keeping up with inflation over the last 3-4 years, and pushing and pushing and pushing. So, yeah, I agree. Margins for banks under pressure, margins for corporates under pressure as we go through the end of this year. It's really hard for me to see how all of that happens without a recession in the US. And let's be honest, it's what the Fed's been pushing rates up to achieve. Every hiking cycle should end and normally ends in a recession. So I think it will do again.
We need the bond market call then, Luke. That's the missing piece of this. I've got a 10-year right now lower by 7 basis points to 342 off the back of the Philly Fed data earlier this morning, weak. Dallas Fed manufacturing data yesterday, soft. You must have a pretty bullish call on the long end of the curve. Is that right?
I think actually we probably prefer the 5-year part of the curve.
Okay.
I don't think it'll matter too much, Jonathan. We've never been longer. And right now, it feels like a great place to be. Long duration, buy assets where you can find them in credit markets that are good quality, investment grade assets, maybe move away from some of the lower tier of banking bonds for sure. But, you know, picking up 5-year US Treasuries, 10-year US Treasuries, I think that will pay off handsomely for you through here to the end of the year.
What kind of numbers have you got in mind? We're in and around 350 right now on the 5-year and the 10-year for that matter too.
I think we could touch 3 again by year end. And as we go into next year, I really wouldn't be too surprised to see a 2 handle come back into the US 10-year.
Wow. 2s on 10s all over again. Keith, when you hear those kind of numbers, what do you think about that?
Well, we've been overweight fixed income. We're keeping it simple on focusing on high quality. We actually went long duration when the 10-year was just above 4%. We still think if the economy is going to weaken, we think that you know, bonds will continue to perform well. We would be looking if to add new duration or extend duration at this point. We would prefer to have something closer to 375. But the big story is that we still think that the peak of this cycle is likely in for interest rates, and that's a reflection of slowing inflation, but also the slowing economic growth we expect in the back half of the year. There's also a pretty big short position in treasuries right now, and that's betting that rates will move higher, and I think some of that will have to be covered as well.
Keith, we'll carry on talking about this. You're going to stick with us alongside Luke Hickmore. Looking forward to that conversation on banks. We'll catch you with Manus Cranny of UBS, on UBS rather, a little bit later on. If you want the other side of the bond trade, that short position Keith described, don't miss the conversation in about 20 minutes with Katie Kaminsky, who is on that side of the trade, short bonds, thinks inflation is going to be sticky for longer. We'll get the other view in just a moment. Equities down about 0.5% on the S&P 500 with some movers. Here's Abby.
John, and the Russell 2000 is underperforming, down more than 1%. That has everything to do with First Republic. Let's take another look at these shares, absolutely plunging, down 25%, with deposits down 41%. Plus, as Kaylee was talking about, lots of changes coming, including workforce cuts, as the company explores strategic options. Turning to some winners on the day, though, GM, these shares are higher. The company has raised their outlook as demand comes in very strong amid solid pricing for their vehicles. 3M cutting 6,000 jobs to save another $900 million in a broad restructuring. They also beat top and bottom, the stock off of its highs, but still up. McDonald's climbing by about 1%. Sales topped estimates as fast food diners continue to pay up. And a similar story for Pepsi. They have raised their outlooks as consumers look past rising prices. They put up a solid top and bottom line as well. Those shares are higher, John.
Abby, thank you. Coming up, the UBS CEO with a big challenge ahead.
The only thing I can say is that we will take our time to make decisions based on facts and not based on emotions. And I'm sure it's going to be a good transaction.
Sergio Adamati on combining UBS and Credit Suisse. That conversation up next.
many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where is it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, COVID's enough of a change that I ought to be able to do something new.
At times of distress in the market, generally the first quarter was very challenging. We still saw clients looking at UBS as a safe haven, and the inflows were coming in from all regions and from different sources. And in that sense, we are very pleased that, particularly also after the announcement of the transaction of the acquisition of Credit Suisse, we still saw inflows coming into our bank. So a sign of confidence of our clients.
That was UBS CEO Sergio Ermotti speaking to Bloomberg's Manus Cranny a little bit earlier on. The Swiss lender reporting its weakest quarterly profit in more than 3 years, and a disappointing outlook for its wealth unit too. Wealthy clients are turning more risk averse. Let's head over to Manus Cranny over in Zurich. Not all bad, Manus. A crazy quarter though for this company. Let's put some numbers on it.
So when you look at the numbers, you go, wow, net income down by over 50%. Pause. 15-year-old litigation issue, mortgage-backed securities. Yes, you've talked about them. You thought you were done. Looks like they're batting that one into the ground. So that's dead. It comes to lending, a little bit weak, net interest income, pumping away on gas, but it might run out of a bit of puff. The issue here is the net new money. Suddenly we're back on that trade again. It's the whole deposit narrative of March. $28 billion came in. $7 billion came in the last 10 days of March after the deal closed. Why was the wheelbarrow not fuller in terms of bringing in net new money from Credit Suisse? Diversification. I'll nip up to Frankfurt overnight, Jonathan. We'll find out where the funds flowed into Germany. The US, you had your very own special banking liquidity, SVB, First Republic crisis, and $8 billion of net new money came from the Americas. So the flow show, Jonathan, is, I think, part of the reason why somebody panicked a little bit this morning, or there was a nervousness and a skittishness, and they hit the sell button, traded down 5%. We've scooped it all the way back up, because I know the math was discomforting for Tom a little bit earlier on, and I'll make it much simpler. There's a truckload of buffer to play with before this CS-UBS trade dents anything into negative territory. I won't give you the math again. You know how it goes.
Well, Manus, let's go beyond the math and talk about the emotion. Obviously, Sergio Ermotti doesn't want to talk about emotions, but you've known the guy a long, long time. It was surprising to many that perhaps he would come back. But when you really think about it, it makes a lot of sense. Did you go to that piece of the conversation about why he came back, what brought him back?
You could tell he arrived into that banking hall this morning. We had a sort of a brief sort of private moment together. We haven't been together for a couple of years. We used to get together for 9 years in a row. This is a man with steely focus. He was able to button his jacket. That was a bit of a war game, on the seat. Ermotti was trim, slick, focused. There were moments of just steely execution. The best line, however, is people tell me you're going to have to sell part of this Swiss National Bank, because of the angst and the social discomfort here. He said, yes, I've met a lot of people that seem to know how they run Swiss banking. He said, basically, we're not going to be hurried. He's not going to be hurried. There's a blueprint. It's a UBS blueprint. I suppose when you get a call like that, Jonathan, it just must be one of those moments. I said, are you back in your old office? And he looked at me and he went, yeah, how does that feel? I said, it feels good. But there was a humility in Ermotti. I think he almost sees it as partly his responsibility now to deliver for the country, to deliver against the social angst. I know you think maybe I'm away off now on a sunbeam, but there is a sense of purpose, of dedication to the country and a mission in Ermotti that I hadn't seen in the previous 8 years. He's been out for 2 years across the road running a major insurance company. This man is bringing people back around him that he knows, that he trusts, that can deliver and can execute. Is now Tom Narratle coming back? We don't know. This is a man that's gathering the forces around him, because this is going to be one monumental creation of a Goliath that is going to be a colossus of Switzerland and of the landscape of banking and asset management. Larry Fink and Jamie Dimon, watch out.
Hey, Manus, world-class coverage over the last 24 hours. Thank you, sir. Manus Cranny from Zurich, Switzerland, on Credit Suisse yesterday, UBS this morning. Back with us for a final thought, Luke Hickmore, Keith Lerner. Luke, sometimes you've got two decisions. You can sell into strength or buy into weakness. For the financial specifically, where are you at?
In credit, we continue to buy, but we're going up in quality. In equity, I would sell into strength.
Why is that, Luke?
I think those margins are going to come under increasing pressure. Earnings are going to be hard to come by. The balance sheet strength is not a story the market's focused on. And we haven't seen the last, I suspect, of deposits changing hands.
Luke, you separated it between equity and bonds. We used to talk about something in between: CoCos, contingent convertibles, AT1s. Now, going into this mess, Luke, you actually pulled back on that. What was it that you saw that made you do so? And have you stayed a little bit more risk-averse around those securities?
I can't say I was worried about Credit Suisse. That would be a brilliant story, but I wasn't. We just saw that the market was overpricing a continuing Goldilocks scenario forever. And really, 81 CoCos reflect all of that. And they were just getting too expensive. So we reduced quite significantly before Credit Suisse went, and then we cut hard into that post-Credit Suisse as well. And we'll probably stay where we are in kind of 5-6% exposure in 81 for our more unconstrained funds right now, because you're still getting a really nice yield off them. But, you know, they're national champions. They are rock solid institutions.
When we saw this mess playing out in Europe over that weekend, Switzerland specifically, we all wondered whether it would upset the trade, Europe, overweight Europe versus, say, the United States. That trade has played out in a monster way on the European side. Just this massive rally since the end of September, when euro-dollar bottomed and the dollar peaked. You've just seen equities rip on the Euro Stoxx 50. A lot of people trying to consider now, Keith Lerner, when to close that trade. Marko Kolanovic at JP Morgan, Mislav Matejka writing recently, when to close the preference for Europe over the US, they answer, Q1 results still to be better, but don't extrapolate. It might become increasingly difficult for Europe to keep beating the United States. Keith, they go one step further over at B of A. Monetary policy has been tightened by the sharpest pace in 40 years. They go on to say, we expect this to lead to recessionary growth conditions over the coming months. Keith, how do you feel about that trade at the moment? It's been really interesting to me to see within the United States tech outperform. But with that, you'd expect the US to outperform Europe, and that's not actually what's materialized, Keith. Would you push back against that trade? Do you expect that gap to close?
Well, I do think that the gap will close. If you look historically, when you go into a global slowdown, the U.S. tends to outperform. But Jonathan, you made a great point. I mean, normally technology is the main factor between the U.S. and international. Tech is doing great. But what's also notable is those European banks are outperforming the U.S. banks by about 30% over the last several months. And they are benefiting from this move out of zero interest rate policy, and they're still relatively cheap. So what we did earlier this year, we actually increased developed international one notch, but it's still underweight. And at this point, we're not looking to increase that. But I will say, I think the European banks are key to watch forward as you're thinking about this trade.
Just hearing more and more pushback against that trade over the last few days. Luke Hickmore, Keith Lerner, to the two of you, thank you. A range of views on this market next week. This week gets bigger with the earnings from big tech, but on to next week. Apple earnings on May 4th. May 3rd, the Federal Reserve May 4th, Apple earnings and the ECB, and then on May 5th, which I believe is the Friday, payroll's just around the corner. Your equity market right now, negative 0.5%. Coming up the morning calls and later, bracing for a bond sell-off. Why Katie Kaminsky of Alpha Simplex thinks higher for longer inflation could fuel another bond rout. That conversation just a few minutes away.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
5 minutes away from the opening bow, down about 0.5% on both the S&P and on the Nasdaq. That's the price action. Let's get you some morning calls. First up, Citi upgrading Squarespace to buy, $40 price target, citing an improving outlook for growth. That stock positive 7.5%. Here's one call for you. Janie Montgomery Scott downgrading First Republic to sell, growing increasingly concerned after the bank's earnings report. We're down there by 24%. And finally, Credit Suisse cutting its Amazon price target down to 140, expecting ongoing cyclical headwinds to weigh on Thursday's quarterly results. We're softer there by about 1%. Up next, Alphabet, Microsoft reporting after the closing bell. That conversation with Katie Kaminsky of Alpha Simplex.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem. I call you up. I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
24 seconds away from the opening bout this morning. Good morning to you all. Just about putting together some back-to-back gains on the S&P over the last couple of days. Right now, negative 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5%. Bit softer, lighter, lower going into a big earnings afternoon after the close a little bit later with Google and Microsoft to kick things off for Silicon Valley. There's the opening bell. That kicks off the trading session. Here's the bond market. Yields lower by 5 basis points, 343.72. Just some of these regional Fed indicators weighing on this bond market, fueling a bit of a rally over the last couple of days. Dallas Fed yesterday, Philly Fed this morning. We're down 5 basis points on a 10-year maturity. Just to pick on the 2-year, we're down 5 basis points there, just about holding on to a 4 handle on 2s. North of 4% all through last week, and just about this morning at 4.04% on a 2-year. In the FX market, touch of dollar strength, euro weakness, holding on to 110, euro dollar 110.14. We're negative 1/3 of 1%. About 30 seconds into the session, we're down here on the S&P 500 by 0.4%. On the Nasdaq by 0.6. If you want to see some major price action, though, check out this name. First Republic, recording its biggest intraday drop in more than a month after reporting a massive decline in deposits. The CFO said this: with the closure of several banks in March, we experienced unprecedented deposit outflows. We're working to restructure our balance sheet, reduce our expenses, and short-term borrowings. Katie Lyons, this is a difficult morning for that bank.
It is. The stock dropping 25% in the first few minutes of trading here, but they, of course, reported an even larger deposit drop than that, 41% in the first quarter. Deposits falling to just $104 billion. The street was looking for $137 billion. So, yes, it was a big miss, also compounded by the fact that that was even with a $30 billion deposit inflow from larger banks who were attempting to stabilize First Republic last month. Now, as for the other highlights, they have said that deposits have stabilized to this point. That doesn't necessarily seem to be shoring up confidence this morning. And as you said, trying to reduce the size of its balance sheet, moderate loan volumes, and cut costs by reducing as much as 25% of its workforce, as well as exploring strategic options. So this is a bank clearly still struggling in the aftermath of the SVB and Signature Bank failures and the crisis of confidence in regional banks. However, it seems to be suffering even worse from that crisis of confidence, which perhaps is exacerbated by the fact that executives didn't take any questions on the earnings call amid that ongoing crisis. First Republic now down 90% year to date. Regional banks more largely still down about 29% in 2023. Of course, both of those dramatically underperforming the wider financial sector. But First Republic, John, it's an ugly chart to look at.
It's a tough morning. It's been a tough year, that's for sure, Kelly. Thanks for that. I talked about some of the research coming from the South Side and mentioned specifically that note from Jenny Montgomery Scott. Here it is. They downgrade the shares to a sell. They write this. Pretty punishing, brutal language, to be honest with you. First Republic results were far worse than we expected, and we believe the company, here's the line, needs to pull off the mother of all pivots to survive. That stock is down 27% in early trading. Another bank reporting across the other side of the Atlantic, we mentioned UBS, they're actually paring their declines right now after falling more than 5% a little bit earlier in Swiss trading. The Swiss lender writing in a statement this: while concerns about the stability of banks have abated, they have not gone away. As a result, client activity levels could remain subdued in the second quarter of 2023. Shanali, great to catch up with you, because when you put this all together, we might have avoided the worst of it for some of these names, but ultimately it's going to be a challenging year ahead for them still.
It certainly is, but remember, the reason they're pairing their gains in the market, John, is because you have UBS coming in with the mother of all deals here. They're about to have the biggest charge here, a negative goodwill charge of more than 51 billion Swiss francs, because they bought Credit Suisse so cheaply. But listen, the numbers themselves, I think you have to notice the pressure on the numbers here, that global wealth management revenue coming in below expectations, and even on the investment banking side, equities coming in below expectations. It tells you two things. One, even the world's wealthy are not immune to tough times. Even though net new money is up, the revenue, again, because client activity is down, is estimates. I'm sorry about that. But the equities trading, the reason it matters, remember, we're one prime broker short in the world now without Credit Suisse. So UBS, as it caters to that investment banking business, can they gain share? This is a bank that has avoided risk very significantly since the last financial crisis. We're going into tougher times. Can they compete with the European banks as well as the U.S. banks as they integrate another behemoth? I think that is the big question as we look to years ahead for these two firms.
They're certainly going to try. Shanali, wonderful coverage, not just this morning, but over the last few weeks as well on the financials, the last few months for that matter. That's UBS. Let's talk about UPS. Their stock is down in early trading by almost 8%. They're projecting annual sales to come in at the low end of its guidance as demand continues to decline. Here's the update from the chief executive, the CEO, writing this: a deceleration in U.S. retail sales resulted in lower volume than we anticipated, and we faced ongoing demand weakness in Asia. We expect volume to remain under pressure. Abby, not looking good for them this morning.
Not looking good at all. In fact, we're looking at the worst day right now for UPS going back to October of 2020. As you mentioned, the stock sliding by almost 8%. The quarter that they just reported basically in line, a little bit of a miss for sales, but it has everything to do with guiding toward the bottom of that outlook, as you were just mentioning, the company talking about the weakness that they're seeing in demand. So what goes up must come down. We have the pandemic trends, some of them reversing, lots of e-commerce back then, maybe less so now. They're talking about weak U.S. retail sales and that they're seeing weaker demand. So again, they're at the lower end of their guidance for sales. In the quarter that just was, while on the surface basically in line, operating profit margins did fall 11% from 14%, so maybe not managing costs all that well. In addition, while the domestic revenue per package rose by nearly 5%, the parcel volume, not surprisingly, down 5%. They have a looming possibility of a strike. They have to negotiate a contract of 330,000 workers by the end of the year. The stock had been, wow, what a chart there. The stock had been up more than 10%, now just up 3.4%. I wouldn't say it was priced to perfection before, but maybe you could say that, John, given the fact that now it's almost even on the year, really eating into that massive gain that it had.
Getting punished. Stock's down 8% on UPS. Here's a stock up almost 8%. It's positive 7.5% right now. Spotify rising after posting double-digit subscriber growth. Ed Ludlow joins us now on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Subscribers coming in at 210 million, 15% gain above street expectations. Monthly active users in at 515 million, breaching that 500 million mark, again above expectations. Real momentum in the quarter, a narrower or shallower than expected loss of $172 million. The only area or metric where they missed was on the top line, but actually if you read across the sell side reaction this morning, the aggregate of all of the metric beats make that sales growth an afterthought. They also gave a pretty bullish outlook for the current fiscal second quarter, where they did state that revenue would grow to 3.2 billion euros. A lot of momentum around podcasts, a lot of momentum and profitability profile around music, especially at a time where like Apple Music and some of their peers they're raising prices. So they were able to grow their subscriber base, their monthly active user base, and then forecast that that will continue sequentially. That's got a lot of the street very positive, up more than 8%, on track for his biggest gain since the end of January, Jonathan.
Ed, you mentioned Apple. Next week, Apple earnings. Let's talk about how busy you and Caroline Hyde are going to be over the next couple of days. Later, Google and Microsoft. Tomorrow, Meta. Thursday, Amazon. Give us the guide, Ed. What are you looking for a little bit later?
Yeah, look, the broad theme is that, on an EPS basis, we're going to see earnings have their biggest drop since 2009. Across information technology on the S&P 500, a pullback of 15%. Those names on your screen, broadly what they're saying is we're worried about the bread and butter businesses, the core businesses, and how they are going to fare. In Microsoft's case, cloud and enterprise software, Alphabet search. What we're looking for is, A, what was the action of layoffs and cost cuts to the bottom line in terms of margin protection? And then B, are there some saving graces? So you take Alphabet as an example. We're worried about that core search business, but does Google Cloud then step up and save the day in a way that AWS has done for Amazon in the past?
Big effort for the Bloomberg technology team. Coverage starts in a couple of hours on Bloomberg TV. Looking forward to it, Ed, alongside Caroline Hyde. The broader market right now, 9 minutes into the session, we're negative 0.4% on the S&P 500. Earlier on this hour, you heard from Luke Hickmore and others from Aberdeen talking about the potential for yields being lower. Let's talk about the potential for yields being higher. Katie Kaminsky of Alpha Simplex going short bonds and saying this: we may see a risk of a strong curve steepening and sell-off in bonds later this year as investors face the realities of higher inflation for longer. Katie Kaminsky joined us right now. Katie, wonderful to catch up with you. I've been looking forward to this all morning. Let's start there. The argument from here for higher yields, Katie, what is it?
Well, if you have to think about inflation tolerance, so if the Fed actually pauses and inflation is higher than target, just in basic mechanics, that affects long-term cash flows. If that's the case, at some point, people might start to realize that longer-term debt is not worth as much as what it is today if we don't have cuts quickly. And I think that's something that people are underestimating because they're just hoping that everything's just going to stop and go back to normal. And I think that they're ignoring the risks in the bond market.
Being actively short is very different to just not being long. Now, Katie, I wonder if these massive swings over the last few months make it difficult being actively short this market. How do you go about doing that?
Yes, this is a good point. I mean, let's just be honest. We saw one of the biggest shocks that we've seen and one of the biggest bites for short positioning earlier in March when you had that flight to safety. But on the other hand, we might be ignoring the long end of the curve, which could have potential to move if we see inflation for a longer period of time. And I think most investors are hopeful that inflation will come down, hopeful that a Fed pause will be nice to the equity markets, and that will waiver this. But I think where you'll see the catalyst of problems is when you actually see the fixed income markets have trouble later in the year, which could predate any sort of equity drawdown.
So, Casey, let's assume you're right. Let's work with that. High yields and do some scenario analysis through other asset classes. Let's push it through equities first. What would you expect to happen with equity leadership off the back of the call that you're making in the bond market?
Well, so first we're going to see a steepening of the yield curve. That means that people lose confidence in the valuation of long-term cash flows, which then affects discount rates, which kind of shows that lending is even more expensive. That's going to put tightening on equity markets, which would cause a lot of problems. On the other hand, it might create the desired results that the Fed is looking for to actually de-inflate assets and then put us in the right place. Unfortunately, that's not a very fun scenario for most investors. If we actually see a drawdown in both equities and fixed income, that's what we had last year, and it's not a very pleasant experience for the 60-40.
Just to recap some of the price action right now, First Republic down 29%, record low on the stock. Brutal stuff. Is trading in and around 11 off the back of earnings yesterday. Deposits much lower than anticipated. The idea that things have stabilized since the first quarter, not enough to encourage any gains in this stock this morning. They had an earnings call yesterday, no questions. The stock is down by close to 30% and struggling to bounce. Katie, how do you think about the financials and how they're involved in the call that you're making currently?
Well, let's take a look at what happened. So when we go back to what happened in March, we really saw people start to realize time value of money has changed. The value of bonds, cash flows, my deposits they need to be different in this environment with higher inflation. And now that I have attractive rates, maybe I'll start actually thinking about shifting money around. And so if you look at what's happened in the banking crisis, you're going to see more of this type of problem as people deal with duration mismatch, cash management, in a world with much higher rates and an inverted yield curve.
Is this a time to buy gold?
Good question. Gold has really rallied on this move, and it is one of the safe haven assets that's actually moved when the dollar didn't move like a safe haven asset. So it could actually be a time where precious metals might be one of the few trends. It's one of the few signals that we're seeing from a technical perspective that precious metals are something that people are buying because they may say, what else do you buy in this situation?
Well, Casey, what would you advocate for when you take exposure to precious metals? Would you do it directly? Would you do it through miners? What would you do?
Well, so you can take direct exposure via ETFs or via futures. There are also indices which investors can take exposure in as well. If they think that they don't want to just park cash, that's something that investors can actually look into for these days with ETFs in particular.
Katie, just out of interest, when was the last time you advocated for a position in gold?
I think pretty often when there's some sort of safe haven trade, gold has been interesting. I mean, metals, to be honest, have been more of a base metals trade in the last 2 or 3 years. So it's been the first time that we've actually started talking about gold, platinum, palladium. It's because those assets were less active in an inflation environment, but more active in a recession, in a recessionary question environment.
Through 2K in the last couple of weeks, backed away since then, just south of that number right now. Katie, wonderful to get your perspective on things. Katie Kaminsky there of Alpha Simplex, taking the other side of that trade. Luke Hickmore was talking about lower yields. Katie's talking about the prospect of high yields and a range of outcomes more broadly cross-asset for that. The equity market, first of all, we're down about a third of 1%. On the NASDAQ, negative 0.4%. Outside of that in the bond market right now, yields lower by 7 basis points. Dallas Fed manufacturing yesterday softer. Philly Fed, that number this morning came in softer too, so bonds are rallying. Outside of the bond market, just the one that gets your attention, First Republic, it's pretty tough. Stock is down by 29%, and moments ago, a record low. Coming up, President Biden making his 2024 run official.
Let's finish this job. I know we can, because this is the United States of America. There's nothing, simply nothing we cannot do if we do it together.
That conversation up next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The question we're facing is whether in the years ahead we have more freedom or less freedom, more rights or fewer. I know what I want the answer to be, and I think you do too. This is not a time to be complacent. That's why I'm running for re-election.
Finally, the President of the United States officially launching his re-election bid, setting up a possible rematch against GOP frontrunner Donald Trump. This as Biden remains locked in a standoff with Speaker McCarthy over the debt ceiling. Bloomberg reporting McCarthy's bill will hit the floor this week under a rule that doesn't allow amendments despite falling short of the Republican support needed for it to pass. Team coverage begins right now with Anne-Marie in D.C. alongside Katie Lights. I want to start with you, AMH. The latest, finally, he got there. I think we've been waiting for this official announcement from the President of the United States for the best part of 6 months.
Yeah, Jonathan, if there's any confusion, Joe Biden is seeking re-election and he's running for office in 2024. He's going to be the undisputed candidate, right? He's the President of the United States, and this is just him making it official. But with a highly produced video, this isn't a campaign event. But what it does do is it sets Biden up to now start fundraising. He just also filed in the last hour FEC paperwork, the Federal Election Commission, so he can start talking to donors. He has a campaign team that's going to be set up as well. So now he's really starting to ramp up into 2024. The big issue he's going to have as he seeks re-election is 2020 was really about, and you talked about this earlier, a referendum on former President Donald Trump. And at the moment, they are trying to, again, make 2024 about President Donald Trump, but at this time, he's also going to have to defend his last 4 years, and that's really where Republicans are going to want to strike attacks, most notably on the economy.
Well, let's talk about his age, because it keeps coming up. 70% of all Americans, according to this poll from NBC News, including 51% of Democrats, don't want Biden to run for president in 2024. The major reason, nearly half of those respondents cited his age as a major reason. MH, this has been somewhat frustrating for me because people describe this as the elephant in the room. And we put all 80-year-olds of the country into one bucket and say that they're not capable of doing a job. And I think actually the real elephant in the room is not that the president is 80 and will be 86 at the end of his second term. It's whether you believe he is someone at 80 that does not have the capacity to do this job. Because that's not true of everyone in older age. Is it true of this individual?
Well, listen, he has had a very difficult in terms of traveling schedule over the past 2 years of his presidency. This is someone who has had huge trips around the world and is able to land and go into these difficult meetings. And at the moment, when you talk to people on his team and you see the president out and about and talks to reporters, his age has not hindered him. We should also know in that NBC poll, Jonathan, a lot of people also don't want to see just a rematch in general of the former president, who is only 4 years younger than the current president. So President Donald Trump and President Biden both in the older age. And a lot of people are just, the whispers are about fresh faces really for both parties. But at the moment, that is going to be something that Biden says, I was able to do it. I proved myself, and watch me, I'll do it again. Age, he understands, is a factor, but he says he's healthy right now, and he's ready to take on 2024.
Kaylee, before we deal with 2024, we've got to deal with this year, before we get to next year, the debt ceiling debate, the kind of economy that we'll be talking about through the campaign and into next year. Where are we on that front now, Kaylee?
Well, of course, the X date is drawing closer by the day. Now, in D.C. today, later on this afternoon, Speaker McCarthy's $1.5 trillion debt ceiling raise proposal will go to the Rules Committee. That's not going to see any changes to the bill. It will just set the floor procedures, because our reporting here at Bloomberg indicates that both Speaker McCarthy and his top lieutenants have told their fellow Republicans this bill will go to the floor as is. They are not going to change it, despite different members of the Republican caucus raising issues on things like the ethanol tax credits, as well as work requirements for social programs. So there is still a question as to whether Speaker McCarthy can get the 218 votes that he needs. But Henrietta Trey's over at Veda Partners this morning says that actually the timing of Biden's announcement may be working in McCarthy's favor here. She wrote, the tone in D.C. is increasingly optimistic that McCarthy will get this bill passed, because McCarthy is corralling his members this morning around Biden's reelection announcement. It is now their base case that this thing will go through. Then it becomes a question of whether or not the White House and Democrats are going to be open with negotiating with McCarthy should he get the votes to pass his bill.
Hey, Kaylee, thank you. Alongside Anne-Marie, the update from Washington, D.C. The broader market right now, 23 minutes into the session, we're negative 0.6% on the S&P. Coming up very shortly, your trading diary. Before we get there, First Republic right now in early trading, trying to bounce down 29% lower, record low.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Almost 26 minutes into the session, we are negative 0.6% on the S&P and the Nasdaq. A similar move on the Russell of small caps struggling. Your trading diary looks like this. Alphabet and Microsoft earnings at the close, followed by Meta on Wednesday, Amazon Thursday, plus US GDP and another round of jobless claims. On to Friday, PCE inflation, UMich consumer sentiment, and personal income and spending data to round out the week. That rounds out the morning for me. Thank you for choosing Bloomberg TV. As always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where has it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right? right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit,